helping out with COVID and the vaccines. So I think on the stimulus, you've heard a larger voice be with the Republican leaders in Congress. But look, they've been effective. When you saw the bill pass the House on Friday, you didn't see a single Republican go ahead and support this $1.9 trillion package aimed at helping Americans.
Emily, always great to catch up. Let's see you soon. Emily Wilkins, Bloomberg Government. What a week ahead we've got for you. The Fed speak kicking off a little bit later today with the New York Fed President, Mr. Williams. And then later on in the week, we hear from Chairman Powell on Thursday. And then on Friday, it's Payrolls Friday in America already.
And really, really important, John, to see the jobs report. And again, I'm going to go to wage growth. The heart of the inflation fear is the fear that wages and benefits going to rise. And the optimists pushing against inflation say, wait a minute, there's no evidence we're going to see wage inflation.
The policy has totally disrupted traditional metrics and data points in the labour market. And Lisa, we witnessed that on Friday when we looked at where personal income was. I think growth of 10%, personal savings, something like 20% in the United States of America. And the correlation between that and the labour market, particularly at times last year, just totally broke down.
Yeah, and there's been a lot of guesswork, which is probably the reason why we haven't seen a really predictable market response to some of the labour market data that we've been getting. I do want to note, there's also a great degree of uncertainty about how much the services sector, John, can bounce back, given the fact that you can't get 5 haircuts for the 5 months you skipped it, right? I mean, how much pent-up demand can we unleash into the economy? Also, given some of the inefficiencies built in, new restaurants that have to get started, new people who have to be hired. And this is sort of a big question mark also as we head into a post-pandemic era, John.
Are you playing down the back half boom?
I believe that's what I heard.
Is that what's happening?
I believe, John, that was
I'm raising
given where the savings rate is right now.
The savings rate could also be put into paying back debt payments, and it's unclear how much can get unleashed all at the same time, given that everybody wants to fly to the same places, perhaps. Can everyone get flights? I mean, I'm just raising issues of the inelasticity, to use Tom's word, of some of these services sectors.
Can everyone get flights? You're worried about too many people going through the airport now?
I'm just saying,
I'm just following up. I'm just asking. Just asking.
I'm staying quiet. I'm just watching her go down in flames.
I don't think I'm going down in flames. I think I'm raising really salient points, John.
The hotels will be too busy, and that's bad.
No, I think it's great.
Because you can't get...
But you have to hire more people. There's a delay.
Oh, you have to hire people too.
Which is good, but there's a delay.
Wait, I'm already in cash.
Just want to confirm that's good. Coming up, Laurie Calvasina of RBC from New York. This is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York City for our audience worldwide, live on Bloomberg Television, here's the price action. A bounce back in the equity market, up about 1% on the S&P last week, down about 2.5%. On the NASDAQ, up about 1.2% last week, down 5%. And on the Russell, up about 2% on the session last week, down almost 3%. You get the picture. A really big bounce back in the context of the moves we saw last week. If you switch up the board and get to the bond market, 2s, 10s, 30s, can you believe it? A high of last week at 161. That was the high of last week. And can you believe that on the week, if you ask someone, what was the move last week on treasuries, just on the nominal yield? Would they say
happened.
a little less than 7 basis points? That's all it was in the end on the week. The amount of disruption by the volatility, we'll talk a little bit more about that a little bit later. Your 30-year yield up by another 8 basis points on a session. Huge move lower on Friday's session, but yields starting to tick higher again. 223 on a 30-year. And the pushback has come from everywhere else except the Fed. It's not come from the Bank of England. It's not come from the Federal Reserve. They like what they see. Why? Because the vaccine rollout is so good and the prospect of reopening is clear. For everyone else, the ECB, Europe, not great. Australia, the RBA, they've got a yield curve target at the front end on a 3-year of about 10 basis points. They're pushing back hard. So in Australia this morning, what do you see? Down another 2-3 basis points to about 1.67. The Aussie stronger, copper doing nicely again. Tom, I think we have to think more about this one in the context of China and the recovery slowing down.
That's totally a China
just a little
play.
bit more.
Totally a China play.
And we're still really constructive in the commodity market. And the data I'm seeing out of Australia, out of China, doesn't support the idea that we're at the cusp of a commodity super cycle, so to speak. A commodity rally, sure, but a super cycle needs China to deliver and deliver big.
Yeah, deliver big, like 8% nominal GDP or even higher. But John, I think to the point, and so important is there is a raging debate in commodities. The same in equities as well. Lori Calvasina with us with RBC. She was superb the last time she was on in framing being in the markets. Lori, you saw the events of last week. Did you change your enthusiasm for equities?
You know, it's funny, Tom. I actually asked a lot of people a question. I said, on a scale of 1 to 10, how concerned are you about what happened in the bond market? And generally, most people I talked to said, 3, 4, 5, somewhere in there. And I think that's probably around the range I was in. I would chalk this up to, something that's concerning, something we've got to keep an eye on. Similar to what we saw, frankly, with Robinhood and Reddit. Similar to what we've seen with the variants, but I would say it's not eroding my case for equities yet. I do think we have to keep an eye on it, but still the thesis is intact for now.
Did you witness rotation or did you witness things coming off the bottom?
You witnessed rotation initially, and I'll tell you what I didn't like on Thursday was we suddenly went from rotation out of the old secular growers into the cyclicals. We kind of had a defensive, kind of anti-cyclical, classic defensive tone that took hold Thursday. So it was a jumbled week, to be honest. Every day seemed a little bit different.
Well, Lori, last week, John in particular kept asking the question, has the rally in some of the consumer stocks, the small caps, has that gone into just recovery and catching up with the other stocks, or are we actually pricing in reflation, and do we have any more to go in that trade? Where do you stand on that?
You know, it's funny. The piece we put out last Tuesday, I think the last line we said we may be embarking just in the middle of one big catch-up trade, and equity markets are not going to pull back until we let that process play out. And I think consumer discretionary is a very different beast in small cap than it is in large cap. In large cap, you have more of the share gainers, kind of the longer-term secular growers. You have some dirtier stuff down in small cap, things that are a little bit more secularly challenged. There is still deep valuation opportunity there. There is a lot of hair on it, though. So I think that it's a combination of both at this point, but I don't think we should underestimate the catch-up potential, because as I talk to investors, a lot of them are concerned that reflation has been fully baked in. I think you can make that generalization to some extent for the broader market, but there are still a lot of bits and pieces like the small cap financials, small cap energy, small cap consumer discretionary, where frankly, it just can't possibly be priced in even on an absolute basis. We're only around long-term averages on those multiples. They're not even elevated.
So let's pair these two conversations together, the conversation about benchmark yields as well as the catch-up trade. How much does the catch-up trade hinge on rates remaining around where they are? In other words, how much can rates rise before we end up starting to talk about the catch-up trade looking a little different because it's a different backdrop?
I think we need rates to keep rising, but we need to do it in a slower, more orderly fashion. I don't think it's the level so much of yields that have spooked investors. It's just the fact that it seemed to happen in such a dramatic fashion. I talked to one investor last week who said, this all just feels a little weird. And I think when you've got extended valuations for the market as a whole, when you've got high positioning levels in equities, that weirdness, frankly, is probably going to make, some eyes really focus on some of the risks, perhaps more than they should. But I do think at the end of the day, we're just continuing to see these little wonky things happen. And that probably means this last bit of catch-up isn't going to be fast and ferocious. It's probably going to be a slower grind with some puts and takes.
Fast and ferocious. Tom Keane, here's the stat of the morning. It comes from David Costin at Goldman. Cyclicals with negative earnings and falling sales in 2020 have returned, drumroll, 25% year to date. Let me read that one again, Tom. Cyclicals with negative earnings and falling sales in 2020 have returned 25% year to date. That's been a story.
And then Mr. Costin there with a 4,300, I believe, on SPX and way out early on a lot of people. Lori Calvasina, I just looked at Russell 2000 small cap in its teacher course. The chart is beyond elegant in terms of trend. Describe the trend, the ammo, the power that you see in the Russell 2000 series.
Yeah, so it's pretty simple. We go back to this catch-up analogy, but if you look at relative valuations between the Russell 2000 and the S&P 500, you have to clean up the data. There's a lot of dirty stuff in the Russell, but if you clean up the data a little bit, we were all the way back down to tech bubble extremes, essentially all-time historic lows on that relative valuation multiple. With the meaningful move that we've seen, just the last few months since the March 23rd lows, small caps are still deeply, deeply undervalued versus large. They're actually closer to that low that they just put in than they are to the long-term average. There is a lot of runway in this trade.
Let's talk about participation, Laurie, a theme I know you've got some details and some data to weigh in on. How broad-based has the participation been in all of this? How well allocated have your clients been to the stories that have performed so well over the last several months?
So look, we've seen, it's hard to parse out exactly what it is that's contributed to it, but if you look at the year-to-date performance stats, active managers on the long-only side haven't performed all that well, and that comes off of a year in which they didn't perform all that well either. And this is all looking relative to benchmark, not looking in absolute terms. So they've been lagging behind those major indices. And I want to go back, to something, you guys mentioned earlier about the low-quality trade. We did a study showing whether you're looking at large cap or small cap, on average, low-quality trades last about 25 months coming out of recessions. We're only about halfway through that. Now, that's a big problem for long-only active managers because they don't like to own that stuff. When they go out and talk to their clients, nobody wants to say, hey, I have this really low quality portfolio, invest with me. I mean, it's just not what they do. And to be fair to them, that's not what outperforms over time. But we do have these very powerful melt-ups in those bits and pieces of the market. And by some accounts, we're probably only halfway through that. So that's the pain trade right now. People keep saying the market's detached from fundamentals. It's detached from the fundamentals that they want to own over the longer term, not necessarily the improving fundamentals we're seeing coming off the bottom.
The melt-up would imply increasing participation. So, Laurie, you're telling us, just to put a bow on all of this, that even if it sounds really, really consensus, we haven't seen the allocation to this story. A lot of people have still missed out on these gains year to date.
I think that's fair. And, I've told some investors there's a consensus to be fair on the sell side. And you guys know me well. I never liked being part of that consensus. But I took a close look at it when I came back. I didn't think that it was wrong. And I saw the room from a valuation opportunity, again, from a thematic perspective. I think the problem is that there's not a uniform consensus on the sell side and the buy side. The buy side has been fighting this. They're catching up. There's a pain trade in place, and they are scrambling to reposition. And that's why you're seeing on some of these down days in the NASDAQ and the tech stocks, they're having to sell the old fundamental story. They just haven't gotten on board with the new fundamentals yet.
Lori, we can't let you go without talking about the GameStop phenomenon and some of the technical oddities, particularly in the small cap space. I was struck by a story that came out over the weekend about Kathy Wood of ARK Investment that talked about how much concentration her bets have. Basically, that she owns more than 10% of at least 29 companies, and it actually accounts for much more than that if you include the holdings of a related investment firm. How much does this create an idiosyncratic risk that's very difficult to model?
Well, look, I think this is all, very, very challenging, especially from an active manager perspective, because, some of these retail names, people are not necessarily going to want to own. Some of the ARK names, some of them have been more popular. Some of them have been less popular. We actually took a look at that in our latest hedge fund filing analysis. But I think at the end of the day, it's just another sort of thing you can put in that category of weird oddities in the market, that we have this new hot category of ETFs. Investors don't own all the bits and pieces. They own some. I think investors, frankly, are not quite entirely sure what to make of that phenomenon, but we do get a ton of questions on it.
Laurie, always good to see you. Thanks for being with us, especially early. Laurie Calvasina of RBC Capital Markets. Thank you. Tom Keene, the cyclical trade, the low quality trade. Going into last week, just absolutely flying.
The trade is there, and as she says, the debate, John, is how much of a bounce is this, and where are we in the cycle? And if you look at the charts, we're trending off the bottom, and you say to yourself, okay, TV and radio is about a 1-year chart, a 2-year charts. What about a 5-year trend on small caps? Is anybody talking about a 10-year trend on small caps?
Yeah. Well, Laurie's basically saying, Tom, we haven't seen the mount up yet either. Some people might push back against that, but a lot of people might think the same thing, that we haven't seen the increased participation that leads to that mount up. We haven't seen it yet, at least in the mind of Laurie Calvasina of RBC.
I did not see catharsis over the weekend. I did not see catharsis last week, John. It was all very orderly. That's not what happens when things shift.
Well, Thursday, Lisa, was disorderly, and that raises some big questions for the Fed later this week.
Yeah, it raises questions, but it also raises a question about what a catch-up trade looks like, given the fact that you might see some of the biggest gainers from that period lose value somewhat significantly if we see rate rises like we did last week. Can I just say that if you look at implied volatility in Treasury yields, it's now the highest since last April.
We're back in a big way. Volatility returns. I don't think the Fed wants to see that, Lisa.
No.
I don't think they want to see that at all.
At the same time, they don't want to move prematurely and blow the rest of the ammunition that they have ahead of what could be potentially something they've got to address.
I'm looking at the Merrill Lynch Move chart, which is the index I go to. It's the dynamics of the yield curve, folks. End of 2016 angst, beginning of 2018 angst.
Yeah.
We had the angst the summer of 2019, massive pandemic angst, and it's just another bout of it, and you reverse and come back down.
But Tom, you will admit, granted, that over the last couple of occasions of those big moves in volatility, the chairman has been a little bit tone deaf.
You'd be correct, except Thursday and Friday, when I was on sabbatical, we had wonderful bond markets.
Just to confirm, you were here Thursday morning. You were on air with us. That happened.
But I was preparing for my sabbatical
but you
Friday.
Weren't. Maybe you weren't.
Capri in 24 hours is just
here.
phenomenal.
Physically, I can confirm, Tom, you were with us on Thursday. Futures up 40. We advanced 1%. I knew you were somewhere else, though. In the bond market, yields 144.61 on a 10-year, up 4 basis points. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Looks like the proposal for a higher minimum wage won't be in the coronavirus relief bill. Senate Democrats are shelving a plan to use tax hikes on big businesses to get them to raise wages. The concern is it wouldn't be possible to get all 50 Senate Democrats on board. The House passed the relief bill over the weekend. The Biden administration is looking for money to fix America's infrastructure, but it's ruled out raising the federal gasoline tax. Here's Transportation Secretary Pete Buttigieg.
The president's made a commitment that this administration will not raise taxes on people making less than $400,000 a year, and so that rules out
British judge spoke to Bloomberg's Kevin Cirilli. Andrew Cuomo has gone from being called America's governor to facing multiple scandals. The New York Democrat now faces an investigation over allegations of sexual harassment. Cuomo's also been hurt by revelations his administration hid the number of people who died from the coronavirus in nursing homes. And Netflix and Walt Disney were the big winners at last night's Golden Globe Awards. Disney grabbed the top award. It won for Best Dramatic Picture for Nomadland. Netflix especially dominated in television with The Crown and The Queen's Gambit. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Today, a Bloomberg exclusive conversation. JP Morgan Chase Chairman and CEO Jamie Dimon, live at 1:30 p.m. Wall Street time on Bloomberg Television and Radio.
we've got to get away from that chain of thought, George, for the following reason. The only way you really know the difference between vaccines is by comparing them head to head.
Dr. Anthony Fauci there, speaking on ABC this week. From New York City this morning. Good morning. Alongside Tom Keane, Lisa Abravis, I'm Jonathan Ferro. Some really encouraging news around vaccinations in America. A bounce back to 1.74 million doses per day administered in the past week, and J&J now in the mix as well. Here's your price action this Monday morning. Good morning to you all. We look like this on the S&P 500. We bounced back there by 38 points, up 1 full percentage point on the S&P. Yields are higher, the curve is steeper. It's a mild move though, not the moves like last Thursday. Yields up by 3 or 4 basis points to 144. And a bit of dollar strength against the euro. It's mixed in G10. Euro dollar, Tom, back to 120.38 and down a third of 1%.
VIX in almost 3 points, 2.78. 25.17 isn't normalcy within the recent 90 days, John, but 25.17 is actually pretty good, don't you think?
I agree. We're getting better. We're getting better compared to where we were, relatively speaking.
You know, we'll see how it gets open. Europe trading nicely, and we'll see if we can do better than these futures here as we move to 9:30. Right now, as John mentions, on the pandemic, it is good news. Jennifer Nuzzo joins us with Johns Hopkins, and she's particularly good at the epidemiology of all this and the trends of our epidemiology. Dr. Nuzzo, I see a linear trend in deaths. I see a linear trend in hospitalizations. Where is your tip point now on that trend? Where out there is the good point for Jennifer Nuzzo?
Well, the good point is nobody going to the hospital and nobody dying. Unfortunately, we're not there yet, but we're getting close. I mean, these vaccines are really extraordinary, and we've gotten quite lucky to have now 3 vaccines that are going to be able to keep people out of the hospital and keep people from dying. So we should see that, you know, I think in the coming months. I'm quite excited. The limiting step right now is just getting them into arms.
Okay, 4,000 deaths, and then one series I looked at, we're at 2,000 deaths now, and even seeing better statistics, nicely below 2,000. What is the significance of getting to the next 1,000, to have 950 deaths? What does that mean for American society?
I mean, it's extraordinary. I mean, 950 deaths is too much still, but it is extraordinary given where we were, which was one day we, you know, surged past 5,000 deaths. So it's important to kind of look back and remember how bad it has been, but also recognize that we still have a long road ahead of us. And it will start to get slower in terms of the reduction in deaths, because one of the things we did was cover the groups that are most likely to die, like nursing home patients, which account for 1/3 of deaths. So that quick progress is important, but that pace won't probably last for all of it.
Dr. Nuzzo, yesterday Anthony Fauci said that he expects that school-aged children will start to be vaccinated perhaps at the beginning of next year. Can we get to herd immunity before school-aged children can get vaccinated?
Yeah, I mean, herd immunity is a really funny thing. It's actually a really complicated topic, and it depends on where you live and how much natural immunity there is, how much vaccine is being rolled out, and also how much people interact with each other. So I'm actually confident that we'll see a sustained decline in cases before we see that happen. We know kids can get the virus, they could spread it, but not quite as well as adults. So I think by fall, things should look a lot better than they are right now.
There's also a question, and Anthony Fauci really pushed back on the sort of all clear that seemed to be gaining consensus that if you get a vaccine, you will not be able to spread the virus. He seemed to say, you know, we don't know that for sure, and you still could. What do you think about that, given sort of the conflicting data that we've heard?
Sure. So we've heard some data that actually makes me optimistic that we will see a reduction in transmission. I don't think we've seen that with a lot of the data that we have so far, that it will completely prevent transmission. But a reduction in transmission is a win as far as I'm concerned. I mean, really, we've already defagged the virus by taking off the table, you know, for the most part, deaths and hospitalizations. And if we can also reduce cases, that would be great.
And John, what's so interesting here is the optimism of Dr. Nuzzo versus a 3-week proposed lockdown in Paris, or the challenges that we see within the British press. I mean, the gap has never been wider.
A different world, particularly on the continent in the Eurozone, where they've really struggled to roll out this vaccine. So, Jennifer, let's finish there on some good news around the United States. We came into the new year. If there was one worry, I think a lot of people worried about supply. Can we just park that worry now? I look at some of the numbers, and it just feels like supply is just not going to be an issue at all in this country.
Yeah, I mean, it's still an issue in the sense that, people like me who are in a priority group can't get it, but it's getting better, and I am hopeful for the future. And then we'll have to deal with how do we actually get it into arms. There'll be some bumps there. There'll also be the bumps of people who may not want the vaccine and very much should get it because they're vulnerable. So we still have some challenges ahead of us, but overall, I think it's looking a lot better than where we were this time last year.
Doctor, the hold up now, do you see it as a logistical one, or do you see it as one that comes down to acceptance as we get further down the line?
I think we're going to still deal with both for quite a while. Right now, the predominant challenge is logistical, and not enough vaccinators to get into arms, and not enough vaccines. The vaccines, we're going to have an increasing abundance, and then we'll have to think about the vaccinators, and then willingness to get it has always been an issue. But as the demand is able to be met more greatly, we will see more prominently the hesitation issue that we need to address.
Doctor, we appreciate your ongoing contribution to this program. Thanks for being with us this morning. Jennifer Nuzzo there of Johns Hopkins. Thank you. Tom, the numbers are better in America. The cases, the deaths better, the rollout better, the vaccinations better. We are trending on a whole series of fronts in the right direction.
Yeah. Well, I take real issue with those looking at the other countries. We spoke to the Israeli health minister last week. That was a very constructive conversation. The sheer size and mass of America gets you to where President Biden and, frankly, President Trump have been, which is this has been a success given 300 gajillion people.
So far, so good, Tom, and I totally agree with you. And you compare and contrast it to what's happening in Europe, where it's become not just a supply issue. They've got some of the supply now, and now they're struggling to get it into arms. So there's two big issues playing out in Europe, acceptance being another one.
Well, the acceptance is one, and that's a social part. I'm saying to everybody, I got tested this morning, folks. We've got this wonderful service here, and I'm saying to everybody I run into, are you being vaccinated? And, there's some people that are afraid out there, but I get a sense, John, even that trend is improving.
So you've been vaccinated, and Lisa, I think this raises the big question, I think, as the year grows a little bit older. What are you allowed to do once you have been vaccinated? And Dr. Fauci's clearly hesitant about telling people this because he's still not convinced about whether you can pass on the virus even if you have been vaccinated.
Yeah, there has been some encouraging information out of the United Kingdom and out of Israel, but we still really don't know, and he doesn't want to sound the all clear and then exacerbate the pandemic. I do want to just mention the Saturday Night Live sketch with Kate McKinnon about the vaccine and how confusing it is in terms of who's eligible in which state. And she raised a really good question, Tom. I'd like you to answer it. Do you get the vaccine in the same arm, both jabs, or do you use different arms?
Oh, no, I got it in the same arm because they had to hold my right hand. There's like...
You couldn't handle it?
Staff, yeah. Ken Langone came over and held my hand.
Ken helped you.
Yeah, you get the white gloves service, huh?
Sometimes this program's so off the rails. I don't know if we're being serious or not at times.
Can I
be
serious?
That was serious. That was a serious
I don't know where the clock is right now. Can I get wonky on you guys?
Please.
You go down in flames in the CFA on butterflies. The butterfly is a thing to watch right now in a measurement of the bond market, and the butterfly's coming back. They're flying north from Mexico.
You're going to tell us more about that, Tom.
The butterflies
in just a moment.
Looking pretty good.
You were technical for a second, and then it got crazy. This is Bloomberg.
Yeah, the monarch.
We have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
The market is pushing the Fed as to whether or not it's going to be able to hold the line.
What we're hearing from Fed officials is that we're just seeing an adjustment up. How far further this goes, I think that is the question.
We will get higher inflation, but it's mostly because the U.S. economy is going to come roaring back.
Consumer confidence is going to come back and they will be spending.
We do have inflation. We do have inflation fears. That is good for the reinflation trade. That is good for the cyclical trade. And that's where we want to be.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The bid is back in the equity market from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Equity futures up 36. We advanced Tom Keene about 1 full percentage point. We conclude the week ahead with payrolls. Before we get there, Chairman Powell.
Well, we got a lot of Fed talk, and yes, I think the jobs report is important. John, what I would note on is a follow-through from Friday, and these are better than good markets with some stability in bonds, even with a higher yield right now, but equities are on a tear to reset near record highs.
Yields are up, Tom. What do we say when yields are up and equities are up? Yields are up for the right reasons. Is that what we say? Yields are up 5 basis points.
Yes, John, I think that's well said. And on March 1, we begin to firm up really good economic growth into this second quarter. That's the expectation that's out there. And then the mystery, John, out to the third quarter, we've got a guest coming up with one of the most nuanced equity calls on the street.
Jonathan Golliver, Credit Suisse, coming shortly. Lisa, up 5 basis points on 30s to 220, on 10s up 2 to 143.
One of the key questions is, at what point does higher benchmark borrowing costs lead to perhaps restrictive conditions? And you were talking about this last week, John, in the corporate debt markets. And you did see, actually, the spreads, the extra yield over benchmarks rise in tandem with higher yields last week. Again, this raises a question: when does it start to bite in a fundamental way? And that really is unclear.
Do you think that was the volatility or the level? Or both?
I think it was both, right? I mean, the idea that, are we seeing another 2013 taper tantrum? If that's the case, you don't want to have any kind of exposure to duration. You saw investment grade debt underperform.
But the great is then you click in with price down, yield up, whatever you're looking at, John, and fixed income. There's that, just like the equity market. When do I get in? When do I get in? When do I get in?
Yeah, the tantrum without a taper. I guess that's what last week was, Tom. In the market this morning, good morning to you all. This Monday morning, we look like this on the S&P 500. We have a lift by 0.9% on the S&P, up 35. Talked a lot about this bond market. Yields are up, the curve is steeper. Curve steeper today on 2s 10s by a couple of basis points, on 2s 30s by 5. Yields are up by 2 on a 10-year to 143. And that commodity rally back, I have to say, Lisa, I was really surprised to come in this morning. Looked at the PMIs from China, thought you'd see a real weight to the commodity complex, and you don't. Well, copper's positive, crude's positive.
You also see, though, a real tightening in some of the oil supplies, and certainly you're seeing drawdowns in some of the inventory. So perhaps that's behind it. I don't want to read in too much to one day's move. We'll have to see, and you do raise a good point. You also said the tantrum without the taper. Are we going to get the hints of taper? We've got a lot of talk from Federal Reserve officials: John Williams, Lael Brainard, Raphael Bostic, Loretta Mester, Neil Kashkari. That's just today. The parade continues tomorrow and through the rest of the week. The drum roll to Fed Chair Jay Powell on Thursday. Really, how much are they going to push back against the bond market's move? John, you're right. They haven't been willing to do so up till now. At what point will they start to get concerned? 10 a.m. we're going to be getting some data, manufacturing information from the United States, which may be dealing with some interference with the weather that we saw out west, as well as supply chain disruptions. We're also going to be getting construction data. Very interesting to see how much the increase in mortgage rates has affected the demand for housing and the demand to build new homes. And then at 1:30 p.m., Jamie Dimon, Chief Executive Officer of JP Morgan, will be joining us on Bloomberg Television. A lot of questions here about the economy.
and about the competitive landscape. I know that you're not watching this perhaps as closely as bond yields, John, or perhaps you are, but I find it interesting, the new entrance into this race, with data being the key component of what distinguishes one player in the fintech world from another.
I totally agree. Interested to hear what he's got to say on the competitive environment. Jane Fraser taking over at Citi, I think, taking the helm today, so good luck to Mrs. Fraser over there too. But on the bond market, I think, Tom, it's always interesting to hear what Mr. Diamond's got to say about the price action, about markets. He's always got an interesting take.
He's got an interesting take, and it's wrapped around, you know, all of his work in the Midwest years ago with Bank One and then over to JP Morgan of running a business. The most important thing, John, an observation on James Diamond is he really points out it's day-to-day hard work to run a bank. How does Walmart jump into that without the experience, the day-to-day grind of the systems of successful banks?
Well said, Tom. Totally agree as well. Tom, is it too early to give you an estimate on payrolls for Friday?
Oh, way too early.
Never
my
too
head's
early.
not there.
180 if you want to know.
Go for it.
180.
You got it, whether you thought it was too early or not, Tom.
I was going to do that anyway.
I know.
John, I got to get to Thursday full on the tots. I mean, you know, Gareth's going to be out there doing it again.
Gareth. You going to tell anyone who Gareth is? Or are we just keeping that?
Apparently everyone knows.
Just think if Gareth
just
got
assume
together
knowledge
with
on this
Gwyneth,
program is just amazing.
Just think if Gareth and Gwyneth were an item, it'd be, you know.
Yeah, sure.
It'd be positively Welsh.
Yeah. Jonathan Golub joining us now, Credit Suisse Chief US Equity Strategist. John, good to see you, sir. Great to catch up.
Good to see you.
Yields are higher. Yields are up for good reasons. You talked about this in the last couple of weeks. I read through the research with you and the team that this market can do well when yields are higher. I think we need to find a point on that, John, after the price action of Thursday. Your thoughts, please, sir.
Well, I mean, there's a few things. First of all, you have to look at the full cost of capital, which not only includes treasury yields, but also credit spreads. And if you look at high yield spreads since the Pfizer announcement, they are down more than treasury yields are up. That's the big story. The cost of corporate borrowing over the last 4 months continues to actually improve, even though treasury yields are higher, and that's the missed story.
John Golub, I want to go back to the heart of your distinctive call with equity optimism, and that is you believe tech will still participate. You have heard countless people say, sell the big tech, sell the big tech. It's yesterday's story. Give us that distinction.
Well, first of all, Tom, we're neutral weight on tech because we do think that this is all going to be, first of all, we think the opening is going to be much bigger than people think. Our call is really around corporate profits. And you want to buy operating leverage. You want companies that jump the most in an improving economy. And tech does okay, but it doesn't do well as banks, which is our favorite group, or industrials and materials and energy. So we think that they'll be in the game, but we do not think they'll be leading this.
One thing that I was struck by, Jonathan, is that you raised your forecast for the S&P on February 23rd. You had previously raised your forecast on January 7th. It seems to be this moving target. What has surprised you so much in terms of strength that has prompted you to raise your forecasts twice in 2 months?
Yeah, I mean, it's the earnings outlook is just crazy. I'll just give you a couple examples. In the fourth quarter, we beat the estimates, the actual results, by 17%. Now, typically, a company will beat by 3% or 4%. 17% means that everybody's numbers had to be adjusted because your jumping off point just got a lot higher. That's number one. Number two is if you look at a few really important groups, higher interest rates, very big positive for financials. Higher oil and copper. Do you know that oil and copper, if things go as expected, that they will be up 50% in 21 versus 20. That's enormous for industrials, materials, and energy. And that stuff matters a lot. So those are some of the incremental things. But it wasn't that we think PE multiples are going to be the story in the next 12 months. It's all corporate profits.
Lisa coming in hot on a Monday morning.
Lisa.
Just taking out John Golub for raising his price target twice in 2 months.
No, I was trying to highlight the moving nature of this economy and this market, how difficult it is to predict. And Jonathan has been very transparent about it. Jonathan, kudos to you for acknowledging what you haven't necessarily been able to pinpoint immediately.
The banks have been flying. I think we're still up 15.5% on the S&P year to date on the banks, John. It's been a great trade. You need to draw a distinction for us, if you can, at this point already, between who wins the early stage of the recovery and who wins the cycle. And to go back to Tom's point, that secular growth story, the big tech play, is that still the cycle winner for you, John?
100%. I mean, if you have a 5-year or 10-year view, buy tech, buy secular growth winners, and just ignore this. This this is a 9-month trade or something like that in terms of this cyclical leadership. But it's going to be really, really powerful. The question we're getting from people, is it too soon? You know, is it over ready? How much of this is priced into the market? And Lisa, I think that the key here is that we think that the reopening is not even in the market yet. This value trade is still relatively new. And in fact, those cyclical companies are really cheap compared to the rest of the market because they had lagged for so long. So, but John, to your point, if you have a 5-year outlook, you definitely want to be playing those secular winners in tech areas.
John, what portion of cash is looking for a warm spot in the equity markets? Do you look at it as traditional, or is it a smaller amount because of these unusual times?
You know, Tom, I don't spend a lot of time looking at this, and I'll tell you why. The incremental buyer of the market is not is not an individual investor, as much as we're talking a lot about individual investors. It's a hedge fund that incrementally increases their leverage. And the ability for the market to move on basis points of extra hedge fund leverage is the big issue here. And that has, even when you look at all the issues with some of these short squeezes, that hedge fund leverage came down, it just popped right back up to where it was.
John, just final question then. How much visibility do you have with the prime brokerage team? Do you get a feel for how allocated people are to this?
Yeah, and we do. And even there's just a very small handful of big prime brokers. Credit Suisse is one of the top in the world, so we do have a good sense of that trading activity. It seems like there's a fair bit of additional upside. I'll give you an example. Hedge funds are not overweight banks yet, even though when you talk to guys like me, we're all screaming that banks are the most attractive group in the marketplace. There's still overweight technology groups, less so in areas like metal and mining and some of these other, heavy, deep cyclicals. So from that perspective, it gives me a lot of encouragement that this trade is nowhere near over.
John, great to catch up. You're looking well, very relaxed. Jonathan Golub there at Credit Suisse, Chief US Equity Strategist. Do you remember when you worked at a Swiss bank, Tom, and you had to wear a tie? Do you remember that was a thing?
Yeah.
You had to?
Yeah, I agree. I mean, it's all gone by the wayside.
And now you just don't.
That historic interview you did with Jan Hatzius where,
Truly historic, groundbreaking.
Wait, seriously? John, you're saying that people don't do that anymore, and there are two men speaking, both of whom are wearing ties?
We do. We're trying to maintain the standards here, Lisa.
Oh, clearly. Except for that one fateful moment.
Lisa.
What?
Deep breath, it's Monday. More to come. Plenty of time to be bearish and have a go at people about what they're long and raising their price
just
targets.
Falls apart when the futures are up.
Honestly, I think it was an important thing to note. It's moving fast.
Coming up later today on Bloomberg Television and on radio, JP Morgan Chairman and CEO Jamie Dimon, 1:30 Eastern. Looking forward to that. From New York City, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. Senate Democrats will not try to raise the minimum wage as part of the $1.9 trillion relief package. They had considered including tax penalties on big companies that pay low wages, along with incentives for smaller companies to pay a higher minimum. But it became clear over the weekend that getting all 50 Democratic senators on board would be difficult. The House passed a stimulus bill Saturday. Donald Trump told a group of conservatives he's laying the groundwork for a third presidential campaign. The former president stopped a hair short of declaring that he's a candidate for the 2024 race. Still, his 90-minute speech in Florida made it clear he thinks he's the best choice for the Republican nomination. And Iran says it's not the right time for direct talks with the U.S. and European powers on the nuclear deal. Donald Trump pulled the U.S. out of the 2015 agreement. President Biden has offered to take part in talks to revive it, but Iran wants the U.S. to lift economic sanctions first. And President Biden is putting tech and not troops at the center of his strategy on China. He's attempting to rally what officials are calling technology democracies to stand up to Beijing when it comes to semiconductor fabrication and quantum computing. That would append traditional areas of competition such as missile stockpiles and troop numbers. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The past 10 years have seen the rise of names like Siri and Alexa, EVs like Tesla's Model S, wearables like the Apple Watch. What will the next decade bring? Catch a special edition of Bloomberg Technology, 10 years of innovation on Bloomberg Television.
What we know is the American people want this. It's good for the economy, it's good for workers, it's good for families, and so we remain committed to this as a matter of policy. And, you know, whatever the mechanics are on Capitol Hill, bottom line is it's going to make a big difference, and it's a good idea. In the meantime, we are pursuing this rescue plan that is just so important at a moment when we are a long way from being out of the woods.
Pete Buttigieg there, the U.S. Secretary to Transportation, speaking to Kevin Cirilli on Sound On Bloomberg Radio. Kevin will promo that in just a moment. Alongside Tom Keane, Lisa Abramowitz, I'm Jonathan Ferro. Here's your market. this Monday morning, we look like this, up 40 on the S&P. We advance a little more than 1 full percentage point. Yields all over the place. Thursday, your high 161. In today's session, here's the price right now. The scores, 142.90. Yields up around about 2 basis points. For anyone following the cruise ships, the cruise liners, Royal Caribbean up about 25% year to date. Just coming out and monetizing that rally a little bit, Tom. Royal Caribbean commencing a $1.5 billion proposed offering of stock.
What are the airlines doing? That's what I don't understand. I mean, I'm not hearing a huge buzz that they're back. What do you hear, John?
Well, Tom, you bring up this story, and I think it's important. What was GameStop doing? And there was a big conversation over that over the last couple of weeks. Why didn't they come out and do something similar and take advantage of the rally to raise some capital, raise some money?
Well, you know, AMC, I believe, did it, and we'll see.
They did, yeah.
I mean, they're gyrating around this morning. Let's gyrate over to Washington right now. Kevin Cirilli, our chief Washington correspondent. Kevin, I want to bring together all of what I saw this weekend, which is the stimulus coming up with the Senate, a president of the United States looking for new momentum, and the overwhelming reality of 6 House districts coming up in less than 2 years. Dovetail those together into the forward momentum this week in your Washington.
Well, I would add in Syria to that list
really,
as well.
Really, you would add in Syria?
I will, because I think Greg Valliere really captured this in his note this morning, where you've got now Democrats, and this matches my reporting, where Democrats on the far left are raising concerns now on economics and on foreign policy as it relates to Saudi Arabia even. And so there's a breakage point that has occurred in the Democratic Party, and the rift has grown more public. This loss for progressives on the minimum wage issue is not to be underreported. When Congresswoman Ilhan Omar is calling to fire the Senate parliamentarian, the last time that happened was about more than 20 years ago when Republicans did it on a tax effort. I mean, this is a really serious rift that is bubbling over, and the progressives are questioning the centrist Democratic bona fides this morning in Washington.
Are the Democratic centrists and the Republican centrists, are those centrists combined there for President Biden?
Yes, they are. But the question becomes, does that outlast in future fights on infrastructure? You know, I put that question to Secretary Buttigieg on Friday.
On Sound On, I know you did.
And he said that as it relates to infrastructure spending, that they're going to need some of the centrist support in order to get infrastructure through after this nearly $2 trillion battle ends.
Kevin, that was great, just speaking right through that and staying serious through some of our ribbing. I will say there is also a question of the Republican side and how much support there may be for infrastructure. Did we get any sense from the speeches at CPAC about a willingness on the Republican side to work with Democrats on infrastructure or anything else?
You know, it's funny. I spoke with a former Pompeo State Department source over the weekend, and in terms of national security, those sources are supportive of President Biden's actions that he took on Syria. But in terms of the optics moving forward, no, they are not going to be on board for infrastructure unless and only if it provides some type of massive relief for cybersecurity infrastructure or bolstering some other energy grids. But I think from an infrastructure standpoint, the question becomes how they are going to pay for it. And again, that's where Republicans and Democrats are just worlds apart.
I'm not sure CPAC was ever going to be the forum for anyone going on stage to talk about how well they'll work with Democrats over the next couple of years.
I would agree.
Kevin, we've talked so much about division in the Republican Party, and I just don't think we've talked nearly enough about how tenuous this majority is in both the House and how fine things are in the Senate as well. Are things breaking down even more, or are we just shining a spotlight on it?
I think I think we're shining a spotlight on it because it's starting to impact the administration's ability to get other initiatives of their agenda through Congress. And so after this stimulus proposal comes, then they're going to have a fight on immigration and infrastructure, and both are fights that are going to be very difficult. And again, I mean, this is unique to American politics in the sense that the window of being able to accomplish additional legislative items becomes increasingly more narrow as we head into the summer.
That was right where I wanted to go, Kevin Cirilli. What's the then what after the stimulus is approved?
infrastructure, and you know, the appetite for there to be some more cooperation from the far left is increasingly not there.
Kevin, what's the obstacle to getting infrastructure done? I mean, it's amazing. Both parties say they want it done. How are we going to pay for it? After passing the trillions of dollars worth of aid we've done in the last 12 months, we're worried about that.
Well, and even to that point, when you look at the stimulus, and there's $350 billion for aids and funding to state and local governments, what precisely would infrastructure look like in rural America? I mean, from rural America's standpoint, they want to make sure that all of these roads and bridges aren't just being built in New York State or in California, and so they want a piece of this pie. And until they're able to be guaranteed that, you know, it's a difficult sell.
Kevin, good to see you, sir. Kevin Cerruti, Chief Washington correspondent and host of Sound On Bloomberg Radio, weekdays at 5 p.m. Eastern, 3 and 5 minutes.
Those of you on
It's not
Bloomberg
bad, is
Radio,
it?
you're missing a spectacular graphic. It's
there we go. Did Kevin draw that?
Sometimes radio's a huge advantage.
Thanks, Tom.
Hey, Tom, let's get serious. This is exactly what Secretary Summers was worried about in that Washington Post op-ed several weeks ago, that the size of this package down in D.C. would suck all the oxygen out of the room, and the obvious thing that we need to do, public investment, infrastructure spending, wouldn't get done.
And of course, you put Lawrence Summers on the same page with Mervyn King, which is, are we going to invest any of this money in stuff that actually moves towards a better economy and better productivity? And that debate, John, just flat out is out.
Well, I'm also struck by the disparity in what infrastructure means. Are we talking about bridges? Are we talking about roads? Are we talking about electric car pumping stations? Are we talking about internet access to rural areas? Are we talking about renewable energy sources, given some of the pushback that we heard out of Texas? I mean, really, the storms last week just highlight, John, how much debate there really is.
All of the above. And I'd throw a new industrial policy into the mix as well around competing with China. All of that needs to be tackled in a very short period of time in the context of a huge, huge effort that needs to take place. Coming up from 1:30 Eastern today, the Bloomberg City Lab Global City Summit featuring Vice President Kamala Harris and San Francisco Fed President Mary Daly. An interesting conversation. No doubt infrastructure will be coming up. From New York City this morning, good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Getting back to work after the weekend. The bond market getting back to a sell-off. Yields higher by 3 basis points to 144 on 10s. In the equity market, a lift up 39 points higher, up by around about 1 full percentage point. As we count you down to payrolls Friday, this is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
The bid is back in the equity market. Let's get a look at the price action this morning. Good morning. On Bloomberg Surveillance, we bounced back about 1% on the S&P 500, on the Nasdaq by 1.2, on the Russell by 1.8. You get the picture in the bond market. Yields are higher, the curve is steeper. Switch up the board, 2s, 10s, 30s. Repricing expectations for the year ahead. More on this a little bit later. Morgan Stanley looking for 170 year-end on a 10-year. 175 at Bank of America right now, 143 and up 2 basis points. On 30s, up 4. Every week through February, yields higher on the week. Banks, every week through February, rallying with the exception of last week. And Tom, it raises the question, a good move higher in yields, a statement of confidence, the banks do well. A bad move higher in yields, the volatility, the banks struggle. And maybe that's the distinction. And I think maybe we need to get a little bit more clarity from the Fed this week, from the speakers, from Chairman Powell, from Governor Brainerd, from Williams, about what's good and what's bad about a move higher in yields.
John, you're going to get...
Hello, ladies and gentlemen. Okay, are you ready to sell euro? Sorry, buy. I've got signal, and it's time to place an order to buy euro at 120.43, just right here. So if you want to place a trade, if you want to trade euro, here is the time. I'm going to buy at 120.43. All of you guys, if you follow this trade and if you know the strategy, you know what we're doing. And good luck. Hopefully, we will get filled soon. Speak to you later. Bye.
With COVID, because it's really about COVID really driving the economic recovery. That, of course, feeds into the reflation trade, yields, everything else that we're talking about here. Of course, news of that J&J vaccine coming over the weekend. Of course, more importantly, yesterday we learned that the U.S. already shipping out 4 million doses. That expected to arrive at those distribution centers as soon as tomorrow. And, of course, you have J&J saying they'll get about 20 million doses out there to folks by the end of March. So an encouraging sign here. You're seeing all the vaccine makers here get a bid here. In fact, all the COVID stocks are really doing well. Flip up the board because there's two interesting stories outside of this. The first, of course, we just have to start this morning by sort of lifting our coffee cups to Jane Fraser. She starts her first day on the job as CEO of Citigroup, third largest U.S. bank out there. And, of course, she's going to be the first woman to lead any of the mega U.S. banks here. She's got a lot on her plate, of course, dealing with a lot of those OCC requirements on compliance. And another interesting story that kind of crept out on Friday, this involving Walmart and two interesting executives, Omar Ishmael over at Goldman Sachs Sachs, and David Stack over at Goldman Sachs as well.
What do you think, Romaine?
Both of them were instrumental in sort of helping Goldman sort of create a more consumer-facing side to its business. They're going over here to Walmart. Walmart has made it very clear now for several years that it is pushing deeper into financing, deeper into consumer financing. Of course, we all remember the brouhaha 15 years ago when it tried to become an industrial bank, or at least filed for a charter to become an industrial loan bank. Everyone pushed back on that. Not only have the rules been relaxed then, but really the environment has changed so much now. I mean, you don't really need to even go the charter route if you want to offer financial services. There are a whole host of consumer finance companies out there, the so-called fintech companies, that have shown you don't need to do that. They've been taking a lot of crumbs off the plate of Goldman Sachs, Bank of America, and the like, and now you have Walmart, just a major behemoth.
Romaine, to me, it's been a 40-year mess. I mean, it's been an experiment for 40 years, and it's never happened.
Well, it's never happened, and maybe Walmart's one of those companies that are going to make it happen. And I would just push back on that now. You've got a lot of small players out there, or medium-sized players out there, that have shown that they can make it work. Now, whether they grow to be the size and really challenge the Citis and JP Morgans of the world, that remains to be seen. But at Walmart, of course, they've made it clear that they want to make this push. And those two hires are significant. I mean, this is, we're not talking about scrubs here. We're talking about all-stars. They're picking LeBron and they're picking James Harden, and they're saying go out there and take those shots.
He doesn't get basketball, Romaine.
I'm sorry, should I
just
be talking
baseball?
Soccer?
You've got to talk baseball. You've got to talk baseball.
Just say Gareth.
Do I know as much as soccer as Tom does?
Even if you name some soccer names, Romaine.
It's like Gareth and Harry. I mean,
that's right. Gareth and Harry.
Gareth and Harry.
Thank you, Romaine.
I know as much as you do.
Don't confuse him, Romaine.
All right.
Very good.
Romaine, thank you.
This afternoon is, well, John, I want you to bring in Matthew Hornbach. I'm just going to say I love this guy because he started out off the trading desk of Morgan Stanley in Tokyo and really learned a lot about how not to lose money in the odd yen and Japanese debt markets. That makes him unique.
Matt, fantastic to catch up with you, sir. Matthew Hornbach, Morgan Stanley head of global macro strategy. So, Matt, a number of weeks ago, you put out a note about why it's time for real yields to take over. Real yields are going to move high. You expected it to be a gradual move, and we got a violent one. What was the takeaway for you?
Thanks for having me on, John. It's nice to be with you again. Our takeaway is that the economy is going to improve more than most people expect in 2021. That's been the call of our economists, both in the U.S. and globally. And we think that real yields are starting to wake up to this fact. So, yes, we have been expecting a gradual move. And over the past 6 months, it has been gradual. But over the last week, the nature of the move did in fact change. And in fact, on Thursday, and this was mentioned earlier on your show, Thursday really was a violent move. It was one where the Fed, probably for the first time in the past 6 months, got a bit of a rude awakening.
I think it's really important to mention the nature, the character of the move last week, Matt, because on the week, nominal yields are up about 7 basis points on the week, but it's the volatility in between and that violent move Thursday. How do you think that shapes the approach of Fed speakers this week, particularly Chairman Powell this Thursday?
Well, we think it serves to highlight a disconnect between the pricing of Fed policy in the bond market and where the Fed thinks appropriate policy is likely to be in the next several years. What we saw at the end of last week is the bond market pricing in 75 basis points worth of rate hikes through the end of 2023. And that, of course, contrasts pretty dramatically with the Fed's view of appropriate policy being unchanged, being no rate hikes. And so that's something that the Fed is going to have to deal with, we think, in the next couple of weeks. They should be discussing this at the March FOMC meeting. And if we're lucky, John, we may even have yield curve control come up as a question, probably from Michael McKee, who's one of the better reporters in the beat these days.
You got that right, Matt. And of course, he'll have to go last because they can't stand the direction of his, the distinctive nature of his questions.
Okay, guys.
Matt, I want to go.
Position opened at 120.43. Long position. Okay, well done. We open just right here. So let's see how much profit we're going to make. Okay.
Catharsis to clear the market for the Zentner call.
I think so. I think the violence of the move, just the fact that after the 7-year note auction, which tailed pretty badly, probably washed out a lot of weaker longs in the intermediate sector of the yield curve. Hard to hold on to a position when it moves that violently against. So I do think that that was enough probably to clear out a lot of bad positioning in the bond market. But as we saw, and as I mentioned, it really brought the pricing of Fed policy to a level that we haven't seen since the taper tantrum in 2013. And we did this analysis in our last institutional research publication, where we saw back in September of 2013, we were pricing in as much term premium in the front end as we are as of last week. So, I think that the market is going to take some of that back in the next couple of weeks. And look, I hope the Fed realizes that they're really playing with fire here. If they allow this to continue, it will continue because the bond market vigilantes, they've got pitchforks out.
So what do you think the Fed should do?
Well, look, I think they need to acknowledge either that the market is onto something, that, look, maybe no hikes through the end of 2023 is a bit too dovish of a policy prescription, or they need to push back in some way, probably verbally. But also, I do think that the tool of yield curve caps was designed for exactly this scenario. So I certainly don't expect them to implement a yield curve cap, but there's no harm in talking about it, especially given where markets are priced today.
Meanwhile, even as we saw real yields rise pretty precipitously at some points last week, we saw inflation expectations over the longer term fall to the lowest levels of this year. What do you make of that? Is this a reliable gauge? We take a look at break-even rates as an inflation measure, or is the market telling us something we really have to listen to?
No, Lisa, I do think it is something we have to pay attention to. Our view is that break-even inflation rates today are mostly being driven by the risk premium embedded therein. And the Fed does need to pay attention. And I think what we saw last week was this. Look, if the Fed allows the pricing of policy to become any more hawkish, they really start to risk their inflation goal of modestly overshooting the 2% level. So they do need to pay attention.
Matt, final question from me. You brought up the vigilantes, of course, coined by Eddie Ardeni back in the 1980s. And most people assume that term basically means it puts pressure on the policymakers, not monetary policy, on the fiscal policymaker. Now, you're looking for 170 year end on a US 10-year. Do you think any of this price action we're seeing right now really puts pressure on the fiscal policy story down in D.C.?
I don't think so just yet. I mean, on any historical measure, interest rates are still extraordinarily low. If you look at the 30-year long bond yield, that is still below the Fed's vision of where neutral policy rate is, which is 2.5%. So we still are at historically low levels of interest rates. I do think that there's plenty of scope for more fiscal stimulus, and it looks like, John, we are going to get it.
Matt, good to catch up, sir. Send our best to the team, won't you? Matt Hornback there of Morgan Stanley, the head of global macro strategy. Tom Keene looking for 170 year end now on a US 10-year yield. Right now, 144.
You get 170, and it's how you get there, and it's the speed, John, that you get there. And critically, to Zentner's call, it's the underlying economy dovetailed around that yield, and that takes data. The data's a little bit delayed.
What you get from the strategist, Tom, is a lot of thought. You never get them turning around and say, we'll get there next week, given the price action of the last week. But
John,
who knows?
This is such an important thing, is how the street consumes all the guests that we talk to. And you're right, it is food for thought. It's food to help you frame your belief, your setup in the markets, not buy, hold, sell.
Lisa, we took out some year-end price targets in Thursday's session, and some.
Yeah, and people had to change their forecast as a result. I'm struck, though, about what the market is expecting from Fed Chair Jay Powell this week, in addition to other Fed officials. Are we going to hear yield curve control? Are they going to try to talk down the move? And what is the potential moral hazard, John, if they do, if they react to every tantrum?
Here's my thing right now. They're more concerned by what happened at the long end, that huge intraday swing, or more concerned about a market pricing in hikes way before they're looking at doing interest rate hikes?
I think all of the above, yes.
All of the above, yes. Coming up, 8 a.m., David Riley, Bloomberg Asset Management. I don't know, what was that?
Well, I mean, honestly, I have 15 seconds. You want me to elaborate on that?
So much to say.
I do have a lot to say, but not in 10 seconds.
So much to say. All of the above, yes. Futures up 40. We advance 1%. And now I've got to work through some time now. Try to make up for it.
Instead of just blaming me for running up against the end.
This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Looks like the proposal for a higher minimum wage won't be in the coronavirus relief bill. Senate Democrats are shelving a plan to use tax hikes on big businesses to get them to raise wages. The concern is it wouldn't be possible to get all 50 Senate Democrats on board. The House passed a relief bill over the weekend. Immigration will be the main topic when President Biden holds a virtual meeting with Mexico's President Andrés Manuel López Obrador today. The Mexican leader plans to propose a labor program that could bring up to 800,000 immigrants a year to work legally in the U.S. A senior administration official wouldn't say whether President Biden supports the proposal. And President Biden is urging Amazon workers to vote in an Alabama unionization drive. He says employees should be able to make their own choice about whether to join a union free from company pressure. Mail-in voting for the 6,000 warehouse workers began in mid-February. And Andrew Cuomo has gone from being called America's governor to facing multiple scandals. A New York Democrat now faces an investigation over allegations of sexual harassment. Cuomo's also been hurt by revelations his administration hid a number of people who died from the coronavirus in nursing homes. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Start your mornings with with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
It is scary to think, particularly given all the liquidity that the Fed has pumped into it, that we still find ourselves in this situation. So yes, expect that choppiness because there are structural issues at a time when we've got more and more Treasury securities being put into the world that need to be absorbed.
Marvin Lowe there, State Street Senior Global Market Strategist, touching on the supply issue. We're light on supply this week. A lot of T-bills next week, 3s, 10s, 30s coming from the Treasury. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. We look like this. We're up 39 on the S&P. We're up a little more than 1%. We bounce back and take a bite out of last week's losses. In the bond market, yields are higher by 3 or 4 basis points to about 144. And Tom, you've mentioned it a couple of times this morning. Mixed in G10, but there's that dollar strength against the euro. Euro dollar 120.45.
John, thanks so much. Right now, we want to do a value add for you to get the Monday started, to get your March started with a reset on China. We welcome all of you on radio and television. And to Curran, our Chief Asia Economics Correspondent, and he gets us started for a good March. How is the March of China looking, Enda?
Well, look, we had some PMI readings today, actually, Tom, which showed something of a softening in the month of February. But the thing to remember is those readings were really distorted by the annual New Year's holiday in China.
Yep.
And, of course, it coincided with a period of restrictions around the coronavirus. But the broader economic rebound story in China remains very much on track. Manufacturing and exports are going gangbusters, and the consumer is holding up too.
And doesn't it just drive you crazy that every time we get a downside surprise out of China, it's somehow seasonal? Isn't it always somehow seasonal when it surprises to the downside? We knew this already. The economists still got it wrong.
There's an excuse for everything, John. You're absolutely right. I do think the month that we just had was distorted by various factors, though. It's hard to strip away exactly the impact of the holiday. But I think overall, even if you were to say that the Chinese recovery is plateauing, we know that the forward-looking indicators on forward orders remain strong. We know that, take South Korea, for example, their exports of chips are going gangbusters, and that reflects on the kind of production and manufacturing that's happening in China, so it's reflecting Chinese demand. And we know that Chinese consumers holding up too. They're not back to where they were pre-COVID, but they are starting to spend again. So even if you were to say, look, the recovery in China is going to plateau a little bit, it's certainly not in a bad state, and it has been a much faster recovery than even a year ago.
Has the vaccination schedule in China been much better than expected as well? How is that factoring into your future expectations?
Well, it's slower in China. It's been slower actually all across Asia, in fact. So there's kind of a bit of a narrative now with Asia, that Asia was first into the virus, first out of the virus, but there's some people saying now we might be last with the vaccination process. Different reasons for that. There's less of an urgency in China and elsewhere to roll out the vaccinations because, of course, infection rates are somewhat low. But at the same time, a lot of people are saying this process is going to have to begin and start in earnest if all of these economies are to get back in sync with each other through open trade and borders reopening and all the rest of it. So I think you will see over the coming months, and we may even get some detail this weekend at the National People's Congress, I think you will see an acceleration of the vaccination process in China and indeed the rest of Asia.
And the recovery continues. I'm just struggling to reconcile it with the calls for another super cycle in the commodity market. Now, a metric that you're familiar with, must-watch metric out of China, China Credit Impulse. That's been rolling over for a period of time now. Can you just walk us through, A, what it is, and B, what your read of it actually is right now?
Well, look, the point to take on that is that China's recovery hasn't just been based on exports. A lot of it has been down to public spending on infrastructure and other government-related projects in particular. And also through the banking system, the central bank has been channeling a lot of money through those banks to small and medium-sized enterprises or to the parts of the economy that need it most. So the China recovery story has relied a lot on public money and on public support, and that's expected to continue. That's why this weekend we're going to get the National People's Congress, where we'll get the economic plan for the year ahead, Jonathan, and that will give detail on whether or not they're confident enough now to start tapering some of the support, pulling away some of that credit, wrapping up a kind of a deleveraging cycle that they've talked about in the past, or whether in fact they will keep their keep tipping some of that cash into the economy. So I think we'll get more guidance on that at the weekend.
And what does the new Hong Kong look like?
Well, it's a big question, Tom. There's no doubt that, confidence has certainly been eroded, if not shattered in the city over the past year or so. We're in the middle now of another protracted series of charges of pro-democracy activists. I think that there's kind of a dichotomy going on here. On the one side, the financial market and banking side of Hong Kong is carrying on, so to speak, but obviously the civil liberties side and the pro-democracy movement is under a lot of strain.
How are they linked together? I don't mean to interrupt, Enda, but this is so important to our global audience. How is the financial part of Hong Kong linked in any way to the people of Hong Kong?
Well, it's about a quarter of the economy, the broad banking financial services system, so it's a huge employer. But, the financial market here is plugged into what's happening globally. It's plugged into what's happening with China. There's a lot of liquidity around. The markets are booming, so profits are up. That side of things is holding up. But obviously, you can't implement a strict national security law that Beijing is implementing without everybody being impacted. There are concerns about what it means for research at banks, for example, concerns about what it means for calls made by institutions on selling Chinese stocks and bonds and the like. So nobody is escaping this national security law crackdown in its entirety, but there is some divergence on the ground. That is, you've got the financial market side of Hong Kong continuing to motor away, but the civil liberties and the pro-democracy side of things certainly feeling the blunt of the hammer blow.
And when we talk about Hong Kong, I think about foreign policy. And when it comes to China, really at the forefront is Joe Biden's push to recast the rivalry between the U.S. and China as one for technological superiority and the race to be the leader in semiconductors and an independent supply chain in the United States for key aspects. What's China's response been to Biden's tone?
Well, this is it exactly, Lisa. I mean, I'll just point you to the export figures out of South Korea today that show huge demand for these semiconductors, and a lot of that is down to stockpiling by China. So they are hoarding what they can in anticipation of a kind of a U.S. pushback on this front. China themselves have identified technology as one of their core industrial pillars, and this weekend, as I was saying, we'll get details on the new 5-year plan. They will flesh out their ambitions, and a big part of that will be technology, and that will feed into this idea of dual certification or more self-reliance. It's kind of an old idea warmed up, but China seems to be getting more serious about it, and they're going to want to produce much more of their own technological know-how at home, and that includes semiconductors. So I think you're absolutely right, Lisa. Chips and semiconductors and the likes are very much on the front line of this next phase between China and the US now, but China is clearly already moving preemptively, and that's why, as I say, we'll get some more details on that from the 5-year plan in the National People's Congress.
The United States taking it a whole lot more seriously as well, and good to hear from you. Stay well. Bloomberg's Enda Curran there on a situation between the United States and China just at the end of the conversation. And Tom, I think it really fuels the conversation about industrial policy that's taking place here in the United States and coming together under the new administration.
I think it underpins, John, the major call of this year, which is how long do we sustain GDP? We can't sustain GDP unless Asia and China sustain.
You can't sustain this commodity market rally without China really contributing. We know that too. Coming up, David Riley, Blue Bay Asset Management Chief Investment Strategist. You sound like Lisa, Tom.
Markets are just
markets up 40 on the S&P. We advanced 1%. This is Bloomberg.
markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Rates to keep rising, but we need to do it in a slower, more orderly fashion.
The market is pushing the Fed as to whether or not it's going to be able to hold the line.
Consumer confidence is going to come back and they will be spending.
The reopening is not even in the market yet. This value trade is still relatively new.
We do have inflation. We do have inflation fears. That is good for the reinflation trade. That is good for the cyclical trade. And that's where we want to be.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It is a simulcast on radio and television. Thrilled you're with us on a Monday. There was Thursday, a 4-day week, and then you get to Friday, which is the foundation for the lift up we see this morning. John, forget about bonds, forget about currencies, forget about commodities. Stocks lift.
Small caps lift. The Russell rallying. Tom, on the S&P 500 as well, up 39, 40 points higher on the S&P. We have a lift by 1%. Jonathan Golub in the previous hour, I think, was really terrific, talking about how much we've seen a boom in the cyclical parts of this market, the financials, the commodity players, and elsewhere, Tom, and put him together with Laurie Calvasina of RBC. And this idea that we still haven't seen the full allocation, the broad-based participation with the winners of the year so far.
And John, I went out on Twitter today with Anthony Dwyer of Canaccord Genuity, whose great theory is if there isn't a recession, markets don't go down. Okay, it's a generalization. I know I'm going to get a lot of hate mail on this. John, the fact is we're looking at 6 or 7% hate mail on this. John, the fact is we're looking at 6 or 7% real GDP.
Yep.
It's difficult to go down given that economics.
Tony would say, look at credit, look at the primary market and the credit market, and look at the supply, and things are still okay. This is not the back end of 2018, Tom. It's a very different environment.
Lisa, you're reading over the weekend the tantrum that we saw. It was a tantrum. Let's not make light of it as well. What is the outcome of your reading?
Well, the outcome is that there still is borrowing costs at very low rates, but you did see companies start to race to get into the market last week, thinking perhaps yields are going to rise. They better get in while the getting is good. Although I'm trying to pair the message that you're talking about from Jonathan Golub, from Laurie Calvasina, with the message that we heard from Matt Hornback, which is that the Fed has to come out and say something this week to talk down, to calm down the rates market. I'm trying to figure out the consistency here of the urgency may be felt by Fed officials paired with this incredible optimism still seen in equities.
John, we saw 3-4 standard deviation moves in bonds. I would suggest the market's doing the calming down for the Fed.
Totally agree, because the Fed hasn't said anything about calming down yet. And I say yet because they've got plenty of opportunity to later this week. And I asked this question a little bit earlier, Tom, and it's an important one. Are they more concerned about what's happening at the longer end of the yield curve and the volatility on Thursday in, say, 10s and elsewhere? Or are they more concerned about a market pricing in rate hikes prematurely? Two interesting stories taking place.
And I didn't really have an answer for you last time because I didn't have that much time. I have a couple more seconds, and I want to just say on the short term.
You've had an hour.
Okay, an hour lecture on Fed policy. The short term, they're concerned about the market pricing in premature rate hikes that stymie longer term inflation. That speaks to those lower inflation expectations that we see over the longer term. On the long end, on 10-year, on 30-year Treasury yields, that affects the borrowing costs of the United States and the willingness of fiscal policymakers to borrow more money and invest in the economy. Both are a concern to the Fed. The question is how they achieve rates at a level that they see as sustainable.
Where are those short-term rate hikes? Where are they modeled in on the calendar?
Well, they're already starting to be modeled in for 2023. And this is a concern. And,
Lisa,
or even the
in the old
2022
days,
they were starting
worried
to
about
do.
March 17th of the Fed meeting afterwards. And if we really reached out, let me get it up here right now, John. I can do this on the Bloomberg Professional Service, on radio, on TV. March 17, April 28, and June 16th, Lisa. That used to be long-term Fed gazing. Now we're out to 2024.
Tom, the new framework, the whole point of the new framework, the new reaction function, the whole point of the communication of the last 9-10 months has been to say, we're not going anywhere.
Right.
We're not going anywhere. And the market's getting ahead of it. And we're not going anywhere, even if the data gets better and the market's still getting ahead of it.
I'm looking for an entry point, Lisa. Let me look at the futures, up 41 points. Dow futures up 326. I'm trying to get in three big figures on the VIX. John, there's so much carnage in the markets. We're cratering. What do you note in data?
Got to look at the yields on the bond market, back up 4 or 5 basis points. And I'd say take a look at the FX market as well. So the low yielders, the Swissy, the Japanese yen, weakening up against the stronger dollar. The commodity currencies is where your outperformance is in G10 today. Norwegian krona, the loonie in the mix as well.
Listen to you.
But it's the euro, Tom, that I've got my eye on. Euro dollar 120.46.
Exactly.
And whether we do start to see a stronger dollar that bites off the back of this conversation about US exceptionalism, will we hear more of that soon?
We did not get to a 119 on euro. For me, that's a huge deal, and I'm going to take it off the vaccines and the glorious numbers under 2,000 deaths I'm seeing in America today. Let us bring in, within all that we've covered here on a March 1 to get you to that final month of this quarter, David Riley, Blue Bay Asset Management, with us with a broad swath. What part of the market, David Riley, are you most focused on into March?
The biggest focus kind of echoes the discussion you've just been having, Tom, which is, I think, more around the short end of the US rates market. I think that the Fed...
Okay, guys, I'm placing a stop on profit for euro at 120.45. Okay, stop on profit placed, 120.45. So whatever happened, you know, nothing will end up with losing this trade. Let's see what's going to happen. Maybe we'll increase our stop on profit. Okay, well done, all of you who started this trade with me.
Actually going to be consistent with the forward guidance I've given around tapering, and the forward guidance I've given around allowing inflation to run above target for a substantial period of time. So I think just, you know, right now, kind of keeping an eye on the front end of the US curve and rate expectations, and, you know, then how the Fed potentially reacts to that.
Well, it's totally inconsistent with the guidance we've had so far, David, and maybe the forecast change that in the next month. But I think a lot of people anticipating better economic forecasts, but keeping the monetary policy outlook basically the same. Chairman Powell speaks Thursday. Do you expect him to change the script?
I do expect him to push back a little bit in terms of, for the first time, in terms of what we've seen in the rates market. And I think what he'll try to do is just sort of reiterate that, you know, the QE is going to be here through this year, and you know, tapering is very unlikely to be kind of brought forward, and that in itself, I think, will help kind of calm down some of the sort of shorter end. But as I say, it's been interesting because you know, if we look at obviously what the Reserve Bank of Australia has sort of, you know, has been tested, it's stepped up its bond purchases. I mean, the commentary out of the ECB clearly has been signalling concern around higher rates, and you know, the Fed really haven't pushed back in any real shape or form against those higher rates, and it may require you know, a more serious kind of wobble in risk assets for it to do so, because it's clearly, you know, looking at what risk markets and financial conditions as a whole is doing. And again, Lisa mentioned, you know, credit markets have proved very resilient to higher yields so far, at least.
RBA decision a little bit later tonight. David Riley, do you know what's interesting for me and some others as well? The bond market didn't lead this move. Back end of October, we saw the cyclical parts of the equity market rip. We saw credit rally, and Treasury yields really didn't do much until basically the last month, when real yields just exploded. Much of the last 6 months has been dominated by inflation expectations. what is it about the way this market's set up right now that real yields weren't some kind of leading indicator? They almost lagged a lot of this, David. Why?
Yeah, well, I remember, I think we had a conversation, sort of, Jonathan, that we were talking about the sort of reflation theme going into this year and how that was being played out in that sort of, rotation from sort of growth to value, defenses versus cyclicals, but actually the bond market hadn't really responded to that. So, I think you're right. I think the bond market has been catching up. I think what was really been the big change is the Georgia Senate election results, the fact that the Democrats have admittedly a wafer thin, but nonetheless have a majority across all of the Senate as well as the House and White House. And so, we have seen a pretty meaningful increase in growth expectations since the start of the year. And I think, the bond market is now responding to that. But this is where I think you were alluding to before. You get this kind of paradox is that the Fed want to, signal is going to say so very, very dovish, keep rates unchanged, even until 2024, and allow the economy to run hot. The danger there is that the bond market sort of says, yeah, but hold on a minute, I'm a bond investor, and that implies that inflation is really going to pick up potentially. There certainly increases the tail risk. I want to be compensated for that, and that in turn actually leads to a tightening of financial conditions and a wobble in risk assets. So how does the sort of Fed sort of tread that line, if you like, from being perceived to be too far behind the curve, and ultimately that meaning rates ultimately end up being higher than they otherwise would be.
David, just 20 seconds here. Just investment grade credit has sold off. We could see a 3% decline year to date. Is this a buying opportunity?
Well, I think that itself has really been about duration. I think duration, interest rate risk is going to continue to be a headwind for high grade credit. I prefer to be in higher yielding credit where it's shorter duration and you still got a little bit of spread cushion, and some of the shorter duration assets like leverage loans and collateralized loan obligations.
Duration risk has been a story. David, great to catch up, sir. David Riley, Blue Bay Asset Management, Chief Market Strategist from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Busy week ahead. Ton of Fed speak. Chairman Powell concluding that on Thursday. And then on Friday is the payrolls report. Let's get to the price action of this morning. We settled down. We stabilized. We rallied. We bounced on the S&P 500 up 42, up a little more than 1%. Talked so much about the bond market. Just really quite violent in Thursday's session. Yields topping out at about 161, just short of that level in Thursday's session. We're back down to 144, even with a 4 basis point lift on a US 10-year this morning. On a 30-year yield, we break out just a little bit more on 30s. Yields up 6 or 7 basis points to 2.216%.
Oh, the carnage. It's terrible.
That was a long weekend, Tom.
The VIX is in 3 big
Feel
figures.
rested.
I'm looking for an entry point.
Oh, yeah.
It's not there.
What did you do on Friday?
What did I do? I had kennel fee. We went to puppy training.
Very good. You training the dog?
The dog's training us.
Was it frustrating to train the dog? Just comparing and contrasting.
Oh, dear Lord.
$100 an hour.
He's got no idea where I'm going with this. From New York, Greg Valliere coming up shortly. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Senate Democrats will not try to raise the minimum wage as part of the $1.9 trillion relief package. They had considered including tax penalties on big companies that pay low wages, along with incentives for smaller companies to pay a higher minimum. But it became clear over the weekend that getting all 50 Democratic senators on board would be difficult. The House passed the stimulus bill Saturday. Donald Trump told a group of conservatives he's laying the groundwork for a third presidential campaign. The former president stopped a hair short of declaring that he's a candidate for the 2024 race. Still, his 90-minute speech in Florida made it clear he thinks he's the best choice for the Republican nomination. And Iran says it's not the right time for direct talks with the U.S. and European powers on the nuclear deal. Donald Trump pulled the U.S. out of the 2015 agreement. President Biden has offered to take part in talks to revive it, but Iran wants the U.S. to lift economic sanctions first. American freight railroads are launching a lobbying campaign that depicts their industry as a solution to climate change. They've come up with policy proposals that they say would help pare greenhouse gas emissions.
Okay, guys, I will move my stop on profit higher to 120.48. just right here, 120.48. So all of you who follow the trade, who started with me, you need to move your stop on profit. Okay, to 120.48. Okay? I'll speak to you later.
Of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19.
Okay, guys, well done. We close trade, so you can see where we close it. It's all like I said, it's all about how much your broker pays you per pip. So in our case, we have £100 per pip. In your case, you can have £30, £10, £15, £50. So you can calculate, in this trade, we made 5 pips. All right? Well done. Let's see what other pairs will bring us today. Maybe we will catch another trade. Well done. I'll speak to you later.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Starting a new party. That was fake news. Fake news, no. Wouldn't that be brilliant? Let's start a new party and let's divide our vote so that you can never win.
Former President Donald Trump there, speaking of CPAC over the weekend from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bravis, I'm Jonathan Ferro. This Monday morning, your equity market with a lift on the S&P 500. We bounced back from last week's losses, up 42 on the S&P. Up a little more than 1%. Yields up 4 basis points on a 10-year to almost 145 now. Yields up on a 10-year on 30s too. The curve is steeper. The dollar stronger. Euro dollar back down to 120.48, and yet still crude rallying. $62 a barrel on WTI, up 0.9%.
Yeah, but John, in the last hour, what we got here is better equities, and yields are coming up at the same time.
For good reasons, as they say, Tom. Yields are up 7 basis points. I'm with you. Totally with you. we've got this lift in yields, we've got this rally in equities. I wonder how the banks do today. Just think it was the volatility of Thursday, Tom, that just really whipsawed everyone. To see 161
well done.
in just a blink of an eye, click of the fingers, just like that.
Russell 2000 showing a 2% move right now. Right on to Washington here. We go to Greg Vallier of AGF looking at the moment that is out there. Greg, I want to go back to Pew Research 12 months ago where they measured the liberals in America and came up with a very liberal combination of 47% of the Democratic Party. I believe that means a majority of Democrats are not liberals. How does President Biden deal with that with the new animosity?
It's a really big story, Tom, and we saw over the weekend the fight on minimum wage. It's not going to be in this $1.9 trillion stimulus bill. I think it hasn't been vetted. A lot of moderate Democrats don't like it. This is the first of many big fights that will pit the center against the left.
What is the sensitivity, Greg Vallier, of 6 votes, 6 districts difference in the House in the push by progressives, by liberals, to bring Mr. Biden to the left?
Yeah, there's not a lot of wiggle room, absolutely. And I think in the House and in the Senate, talk of a big new tax hike, I guess Elizabeth Warren is out with something this morning, it's not going to fly. I mean, the Democrats in the House worry that they could lose the House in 2022 if they go too far to the left.
All right, so let's talk about that bill that you're talking about that Senator Warren introduced this morning. She was proposing, along with Representative Jayapal, a 2% annual tax on the net worth of households and trusts between $50 million and $1 billion. What is the likelihood, what is the chance of this actually getting passed into policy?
Close to zero. I wouldn't say it's exactly zero, but I'd say it's pretty close. It's a good argument. She can go out and say we're progressive, we favor the people who don't make that much money, but you don't have the votes for something that radical.
Okay, maybe not that radical, but are there the votes to raise taxes in some other capacity later in the year?
Yeah, that's a good question. And I think later in the year, as we look at an infrastructure bill, there may be some increase in corporate taxes up from 21% to maybe 25% on the very wealthy. But some huge wealth tax, I think, has very, very little chance.
Come on, Greg, let's go there. Do you think we can actually get an infrastructure bill passed anytime soon?
Yeah, I do. When people say, Jonathan, that, well, it's $2 trillion or more, it's over 10 years, so it's not like it's all in one year. I think it's going to be tough, but they have another shot at this budget reconciliation. They get to do it twice this year. Once is in the next 2 weeks on the COVID bill. No, I think they'll have one more chance later in the year. I do think we'll get infrastructure.
What will be tough about it, considering that everyone who comes on this program on either side of the aisle says the same thing? They want it, Greg.
Yeah, they do. I think there's a strong need for, bridges, highways, dams, telecom, all of that stuff, and they're willing to spend the money. I personally think they're spending too much money. I think $1.9 trillion is too much. I think we're going to overheat the economy, but it's going to happen.
Greg Vallier, you and I are the only ones in the room that remember the phrase blue dog. What is the linkage of moderate Democrats to the moderate senator from West Virginia and then over to moderate Republicans? Is there a new club? Is there a new get-together we don't know about?
It's a pretty lonely club, Tom. There are some people who would agree that you can't spend this kind of money. Obviously, Joe Manchin is the leader of this group from West Virginia. But I think there are a lot of Democrats and in private who think $1.9 trillion is too much, and there are most Republicans think $1.9 trillion is too much. Maybe it goes down to 1.7 when we get the final bill in 2 weeks, but this is going to be a lot of money.
I remember when people were talking about how the more radical wings of both the Republican and Democratic parties had more clout, and we certainly have seen that in the years in the recent past. Do you think going forward it will be the same? Do you think that we're going to see the Democratic Party skew more heavily toward the left side and the Republican Party skew more heavily toward Trump in a sort of more populist tone?
Well, rhetorically they will, and we saw in the last week a real anger on the part of progressives because Biden wouldn't go along with a $50,000 student loan exemption. So there'll be a lot of talk about about that. But let me just make this point quickly. I think that Biden himself will be the key player. He's not a radical. I call him progressive light, and he's an institutionalist. And I think that he will come down on the side of moderate rather than radical.
Greg, before we let you go, I asked this question to Kevin Cirilli, our chief Washington correspondent down in D.C. a little bit earlier, about an hour ago actually, about whether the divisions within the president's party are getting bigger or whether we're just highlighting them more. What's your take, Greg? You live and breathe it.
I think most Republicans in private, if you gave him truth serum, would say they'll be happy to get rid of him. I mean, he did lose the White House, and Senate, and people don't forget that.
Greg Valliere, AGF Investments Chief, US Policy Strategist, on the path forward, and I hope, Tom Keene, that we can get an infrastructure plan, a bill, passed sometime soon in this country.
Everybody I've ever talked to, John, about this over time, whatever the politics of the moment says, it's all about who's going to pay for it. And I go back to the rebuild of LaGuardia, which is a joint effort of public and private sources. Why can't we do that, John? I don't know about the highways of the United Kingdom, John. I never leave the hotel across from the studios. But John, across Europe that I have seen, why can't we have that infrastructure?
Tom,
I don't get it.
Do you know what the most depressing thing is? Every year when you and I fly out to Switzerland and we get the train and it comes on the platform, they tell you it will come at, and it leaves by the second on time. Every single time.
Plus
every
or minus
single time.
15
and
seconds.
Tom, to answer the question, who's going to pay for it? Do you know who's going to pay for it? The growth and the productivity that it generates.
Then why can't we do this, Lisa?
But part of the problem is we can't agree on what infrastructure is the most important to invest in, right? I mean, it seems obvious. We talk about all of these things, but when you talk about bridges and tunnels, then you have to also think about green energy, and that's going to get a lot of pushback from certain constituents. You have to talk about cellular connectivity. I mean, you just start talking about different interests, and it's not as clear-cut, even though it ought to be.
A point well made. Coming up later today on Bloomberg Television and on radio for good reason. JP Morgan Chairman and CEO Jamie Dimon at 1:30 Eastern. Looking forward to this conversation. A point well made.
Jamie Dimon will make a point.
He will make a point well made. I'm sure he'll make several points well made.
I'm missing something.
Well, I'm going to use that tonight at the dining room table with afterthought. That was a point well made.
There are so many inside things on this program.
There's a point well made.
Coming up, Jamie Dimon later on. Your price action right now, equity futures up 39 on the S&P.
That was a point well
we
made.
Advance
about Walmart.
1 full percentage point. Yields up 4 or 5 basis points.
A point well made.
Unhinged.
I'm being diplomatic. Trying to be. This is Bloomberg.
What's the biggest mistake you made when you were a fresh MBA grad and looking for a job?
Make sure you try to do something that you're interested in and that you think you'll be good at. I just was on a path to law school, and I actually never asked myself why I wanted to go to law school. And I randomly went to an investment banking analyst recruiting event, and I figured out I had an aptitude for it. I was interested in the work. If you're not interested in it, and it's not something you're good at, the money will not justify it. I also think that there's nothing wrong with experimenting. Doing something that you always thought you might want to do, or trying it for a couple of years, you can then go back down a traditional path if that's what you want to do. Try to remember what you want out of a job, where you want to live, what you want to get from it, from personal experiences, from development, from training, from fulfillment, from engagement in the community, and make sure you think about those things up front as you're recruiting and not try to evaluate it after you got there.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
New York City for our audience worldwide. Here's the price action this Monday morning. Good morning to you live on TV and radio. We've got a bid, we've got a bounce, up 1% on the S&P 500, up a little more than 1% on the NASDAQ. A nice rally in the small caps as well, up by about 1.75% on the session. Switch on the board and get to emerging market equities, up 15, 16% on the year so far. Last week, down 6 percentage points. On the month, it's a reset for EM. Does the dollar start to bite? Does this one start to break down? It did for a brief moment last week in a brutal fashion. Will that continue? So we've got to think about a couple of things here. The consensus trades, can they break down? EM being one of them. Here's another, the banks up 15, 16%, just like EM equities so far this year. And yet RBC, Credit Suisse, Morgan Stanley saying we still haven't fully allocated to that bank story. Supported by what? This one. Switch at the board, 2s, 10s, 30s. Yields higher again. Curve steeper, up 7 basis points on 30s to 222. On a 10-year Tom, up to 145. And the pushback that comes this week, if we do get it from the Fed, is it on what's happening at the long end or what's been happening at the short end? This idea that we start to price in rate hikes a little too prematurely, that'll be interesting and important for this bank's trade.
Well, anywhere close to catharsis, John, was a 5 standard deviation move on the 2-year yield last Thursday. That is a big deal. There's no question about it. But we really come right back down here, and part of that linked into inflation. This is, without question, the way to start our jobs week. We've got the labor economy report on Friday. Thomas Purcelli is with RBC Capital Markets, our chief U.S. economist, and does just absolutely wonderful work on wage inflation. That's a huge part of our inflation story. Tom Purcelli, are we going to see wage inflation?
Yeah, I think we can. I mean, look, something that I always found really interesting over the last few months was, as we were rolling into October, just before we sort of had that, the big resurgence in the winter months of the virus, you had companies talking about tight labor markets. Right, you heard it in the Fed's base book, you saw it in the ISM, you saw it in the Small Business Survey. So I think that you can get back to some wage pressure building in sort of over the course of the year. Again, I wouldn't want to make too much of that, but because I think the reality is you don't necessarily need some sort of rampant wage inflation to really see just broad inflation pick up. I think that narrative is real.
Back a decade, back 15 years, there was 4% wages and benefits inflation. We cratered down to the financial crisis, and then, as you say, Tom, we were starting to come back. Should Jerome Powell be afraid of 3% wages and benefits inflation?
Yeah, so I think, and I love this question because I think this goes to sort of the center of the conversation. Is, at what point does the market start to worry about 3%? And I'm not even talking about just wage inflation. I think that'll be really hard to get there to the 3% point anytime soon. But I think you can get to 3% inflation. I think that's a real conversation that needs to happen. I think what we're seeing in the market, particularly over the course of the last couple of days, couple of weeks, I think it's this sort of belief, right, that you're actually going to see more growth, more inflation. It was funny when we put out our forecast for our year ahead back in December. We always thought this would be a very strong year, and it's really shaping up to sort of play out much as we thought, whether it's from a growth perspective or inflation perspective. The one thing that we did not build in was a really massive increase in yields, but mostly because we didn't think people would believe it right away. Like, we just thought it would take a long time for people to really sort of get on board with the idea that you are going to see strong growth, strong inflation. The market has bought into it much faster than we thought. So we basically had to scrub all of our yield forecasts because the market believed it sooner. So I think that's an important idea, right? I mean, the market is starting to believe in that notion, and I think all the evidence suggests that they should believe in it.
All right, there's a lot to unpack there. I want to go back to this idea that we could see 3% inflation, but not likely 3% wage inflation, which raises the specter. I'm going to be absolutely, hammered for this, of stagflation, of the idea that the consumer won't be able to spend as much, that the lower income workers will have that much less firepower in real terms. How does that factor into the growth outlook for the nation?
Yeah, so what I would say is I don't think that you see that sort of that big wage pressure right away. I mean, I think it'll take time for us to get there. I don't discount it as a notion. But I think, again, I'm talking about just sort of in the near term, right? This year, I think that you're going to see that firmer rate of inflation, and then the wage part of it will just sort of lag. Again, this is a very unique setup that we have in the United States right now. I mean, I don't know how many people acknowledge this or want to admit it, but we actually did helicopter money, right? In fact, we're still doing helicopter money. I mean, that's a reality. And when you make the consumer in the aggregate this liquid in a pent-up demand scenario, you're going to see a lot of growth. I mean, that's just that is a reality.
So you were talking also, Tom, that you hadn't priced in higher yields to this extent so soon in the year. How much does that fall into financial conditions? How much does that affect your forecast for either tightening, companies not being able to borrow as easily, or fiscal policymakers being that much more conservative about the additional rounds of helicopter money because rates are higher, borrowing costs are more expensive?
Yeah, I mean, I don't know if there's going to be any sort of, sort of stoppage on the desire to do more fiscal stimulus. I guess we'll know soon enough. I think, look, the reality for the sort of the backdrop is I think yields are probably I think 10-year yields. I'm going to be hard pressed to make the case that they go much higher. Fundamentally, I think that if the natural buyer has sort of stepped to the side for the moment, which we think that they have, sort of foreign buyers, I think that sort of that untethers 10. So I think 10-year yields could actually drift quite a bit higher from here. Again, I wouldn't call that a fundamental view. I would just simply say that the natural buyer is now on the sidelines waiting for things to stabilize. So I don't discount that as an idea. But short of that notion, I think that 10s are going to be challenged to rise dramatically more from here. I think where you will see much more increase in yield is actually in the front end. I mean, I think the very front end of the market is ripe for continued gains, continued rise in yields. And again, I stress, if it is true that people are starting to buy into the notion that you are going to see more growth, you are going to see more inflation, then the natural next step of that is, oh, well, then the Fed is going to have to respond sooner than what we think. And so I think the front end of the market is sort of ripe for increase from here.
Isn't that a direct test to the credibility of the Federal Reserve, Tom?
Yeah, Jonathan, I think you're spot on. I mean, look, there's only so much that I think the Fed was hoping that there would be a point where, or over the course of the year, people just continue to sort of believe in this notion of, okay, things are really not that great, or there's prospects for it to get slightly better or a little bit better. I mean, this is the narrative that Powell's been pushing out. I think that at some point he's going to have to change his tone. I think at some point he's going to have to just simply acknowledge, hey, things look really good. Because otherwise, then I think that's where the credibility part of the conversation comes into play. You can't just sort of whistle past really strong growth. I think you're going to have to acknowledge it at some point. And look, let me be clear. I don't think the Fed is not incentivized to make a forecast of, hey, things are going to look awesome at the end of the year, right? There's no incentive for them to do that. I'd rather them be late to the party, which they almost always are with regard to acknowledging where we are from a growth perspective. But when things are really ripping from a growth or an inflation perspective, you can't say things don't look good, right? Because then I think that calls into question your credibility.
Tom, you've said at some point he's got to address this. Is some point March 4th?
No, I think it's early. I mean, I think, look, on some level, you know, and again, we have to acknowledge that on some level, he keeps on saying, hey, you know, sure, in the medium term, you know, like down the road, things will look better. And I think that's probably the same idea that he continues to push. I think when we get toward the middle of the year, I do think that we'll be more entrenched from a sort of a stronger growth, stronger inflation sort of backdrop perspective. And maybe at that point, you know, we could see them start to acknowledge that. But look, we've been saying for quite some time, we think that they'll start the tapering process later this year. I mean, we're right around the turn of the year. You know, in the context of that, I mean, there's only so much time that he can continue to hang on to this notion of, hey, things, you know, don't look that great and you need as much help from us as we can give you.
Tom, what's your Q3 and Q4 GDP guesstimate? I understand it's really opaque, but what are those numbers?
So, Tom, I'm gonna, because to be honest, I love you. I just don't find that question that interesting. So let me answer it in a different way.
Well, Porcelli went to the Abramowitz School of Charm, I see.
I love it, Tom. Carry on.
Well, please, Tom, continue.
So here's what I would say. I think a really great way of thinking about the answer to that question is this. In my baseline estimate, I have full year growth of 6%. 6.5%, full year growth of 6.5%. I am not building in any makeup for lost 2020 spending, and I am not building in any drawdown of the gargantuan amount of savings that we have in place. If you get some makeup of lost 2020 spending and you see a 20% drawdown of savings, which, let's be clear, those aren't outrageous sort of, you know, guesses here. My 6.5% becomes 11%. Full year growth, right? I mean, that's how, again, I hope everyone understands that. I mean, that's without doing a lot of heavy lifting, you can get to really outrageously strong growth rates in a snap.
Tom, you are welcome back anytime, sir. Tom Porcelli, RBC Capital Markets. He'll be with us in the next hour. Tomorrow, Tom Porcelli of RBC Capital Markets. Wednesday,
Co-host.
Tom Porcelli of RBC Capital Markets.
I love you.
Thursday.
But I just don't find it that interesting.
Tom Porcelli of RBC Capital Markets. And on Friday.
But then he made it interesting. He went from 6% out some factor to 11%, because my question was, you know, what did Lisa say earlier?
Stagflation.
No, but it was like...
It was stimulating, Tom. You got to the point. It was a point well made.
It was
well done.
made.
You know,
A point well done.
It was a point well made. These yields, how about them? Up 7 on a 30-year to 222.
Well
on
done,
10s
John.
up 4 basis points to 144.
I take off one day, and this is the love I get.
You still haven't told us what you did. Long weekend. Did you get some rest?
No, I didn't. It was a day I took off from 2 years ago. It was like a vacation day.
2 years ago. You were off the rails on Thursday, and it wasn't until after the day ended that I realised why, because you had Friday off.
I appreciate your humor, Tom. I love it.
There you go. Do you think he needs some love right now?
Yeah.
Do you think he feels vulnerable?
It was a point well made. You make a lot of points, and they're usually well made.
Celery. Okay, thank you.
Enjoy the drink. Coming up on
Can
the
I
Open.
have one?
BlackRock Financial Head of Global Fundamental Fixed Income Strategy, Marilyn Watson, as Treasuries break down again a little bit this morning.
I love you, Tom.
Yields up 7. Who's saying that? 222
At
on a
least he
30
loves
year.
you.
On a 10-year, 144, up 3 or 4. I think he was saying, I love you, Tom.
That's a point well taken.
I don't think he said, I love you, John.
No.
He was saying, I love you, speak to himself.
No, he was saying
This is how he makes himself
And then
feel
even
better.
worse, he answered the damn question.
Yeah, he did. He's just taking a dig at you, and that's okay.
Yeah, you know,
Can I
get
go?
in line.
Can I go?
Look at those markets.
Just getting ready to leave. From New York City this morning. Good morning. Big week ahead. Payrolls on Friday. Chairman Powell on Thursday. And we're up 40 on the S&P.
We're going to do this again tomorrow,
to
right?
38.49. We will be here 6 a.m. Eastern.
Maybe.
On Bloomberg TV, on TV and radio from 7. Looking forward to it all. Up 1%. And being authentic, genuine. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Looks like the proposal for a higher minimum wage won't be in the coronavirus relief bill. Senate Democrats are shelving a plan to use tax hikes on big businesses to get them to raise wages. The concern is it wouldn't be possible to get all 50 Senate Democrats on board. The House passed the relief bill over the weekend. Immigration will be the main topic when President Biden holds a virtual meeting with Mexico's President Andrés Manuel López Obrador today. The Mexican leader plans to propose a labor program that could bring up to 800,000 immigrants a year to work legally in the U.S. A senior administration official wouldn't say whether President Biden supports that proposal. And President Biden is urging Amazon workers to vote in an Alabama unionization drive. He says employees should be able to make their own choice about whether to join a union free from company pressure. Mail-in voting for the 6,000 warehouse workers began in mid-February. In Paris, former French President Nicolas Sarkozy has been found guilty of corruption. Sarkozy was accused of offering to pull strings to help a magistrate land a job in return for a favor. He was given a one-year prison sentence, although under the French system, he's unlikely to serve it. And Jane Fraser takes over today as CEO of Citigroup. She faces a number of challenges at the third largest U.S. bank. Fraser needs to overhaul controls to satisfy regulators, reshape operations around the globe, and guide the firm out of the pandemics that's forced many employees to work at home. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Valuations, particularly, sort of technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
We're going to launch a massive campaign to educate people about the vaccines, that they are safe and effective, and that they can go and get those shots and be good.
Good morning, everyone. Lisa Bramowitz and Tom Keene. Thrilled that you're with us today on radio and television. Again, a very nice lift to the markets. Futures up 1%. Small cap Russell 2000, Lisa, up 1.8%. And Lisa, the VIX comes in 3 points.
Yeah, last week seems to be an anomaly. That's the message this morning ahead of the market open. The big question, will we see more volatility like what we saw Thursday, Tom?
Right now, on vaccination, we go to science, and it is always good to go to someone with legitimate, original medicine. Dr. Lloyd Minor did historic work over 20 years ago on our inner ear and on the linkages to pain and the brain. Really, really original stuff. And then to Johns Hopkins University, and now at Stanford, where he is School of Medicine Dean. Honored, Dr. Minor, that you could join us today. How do we sell, not the anti-vaxxers, how do we sell the part of America that's afraid of science, they're reticent to take the vaccine? What's your best practice for the politicians in Washington?
Well, thank you. It's good to be with you. I think the science does carry a lot of weight. It needs to be explained in ways that it's meaningful and understandable to people, and also how we behave as healthcare professionals in terms of our getting in line to get the vaccine when appropriate, and communicating that these vaccines are very safe and very effective, among the most effective vaccines and safest vaccines that we've seen for any disease or any condition.
What do we need to do to get in front of the people? I mean, I get that we're going to get X percent of people vaccinated, 20%, 30%. I'll give you that number. It's the next 10 or 20% of America I'm concerned about. Is it a public affairs thing? Is it a media campaign? How do you do that?
I think it's all of those. A lot, I think, of convincing people of the safety of the vaccine is seeing others who are vaccinated.
Totally agree. Yep.
Seeing the results, which we're already beginning to see for a variety of reasons, a decline in the number of cases in the United States, but we have to remain vigilant, but all encouraging signs.
Dr. Minor, there was an article in the Wall Street Journal this morning that I found fascinating, talking about a new era for vaccination, the idea that some of the technology used for the Pfizer and BioNTech, as well as the J&J vaccine that was just approved, this idea that it would push us into possibly curing or preventing other disease. What other diseases do you see as likely candidates to be prevented, to be tackled with new vaccination technology?
I think there's several. One is there's the prospect that we could develop more effective flu vaccines. We know that in an average flu season, the flu vaccine for that year may be 30 to perhaps as high as 60, 70% effective. These vaccines that we're seeing for SARS-CoV-2 have a much higher efficacy rate, certainly at preventing severe disease, even at preventing mild to moderate disease. And the fact that they've been developed so rapidly. You know, the first vaccinations were given FDA emergency use authorization just about 11 months after the publishing of the sequence of the virus. That's a record, and I think is something that we can be hopeful for in terms of future vaccine development in the future.
There's also a question about other illnesses, viruses that have been tamped down by all the social distancing. Have we seen any interesting trends or the disappearance of certain viral strains because people have stayed home, worn masks, and practiced all the things that the pandemic has wrought?
Well, one thing is that here in North America, we've had a much, much lighter than normal flu season. Very, very little influenza in the United States today. However, we're starting to see, as children go back to school, a lot of rhinovirus. That's the so-called common cold virus. So social distancing, wearing a mask certainly is making a difference. And I think we need to continue to observe those precautions for the foreseeable future as a higher proportion of the population gets vaccinated and as we deal with emerging variants as well.
If we have a grind, a day-to-day million vaccine grind, whatever that statistic is, where's your visibility where you start to say we get back to normal? Is it April or is it April of 2022?
Well, the current evidence from our colleagues in epidemiology is that 70, perhaps as high as 80% of relax our guard in order for us to back off on some of the social distancing and masking guidelines that we have today. We're not close to that yet in the United States. I think it's conceivable that we could be, by say, the middle to the end of the summer, if the vaccine rollout goes as we hope and as we expect, then as we get into the later part of the summer, I think we could hope to be able to relax some of those restrictions.
Dr. Miner, earlier in your morning, thank you so much for joining us at the School of Medicine at the Stanford University. He is their dean. Thrilled that he could join us today. Lisa, we got to get back to these markets. I mean, the summary is simple. Yield up, equities up, but there's a different feel, and I like what John said about confirming stronger dollar.
Yeah, there's also an idea of can you get higher yields and higher stocks? Of course, higher yields, lower price. And this seems to be a consensus that if those yields, the higher yields, come for the right reasons, then you can get both. And actually, more often than not, you do get that. The question is the pace of the increase in yields. What we saw last week, by no stretch of the imagination, can be positive for capital markets if that becomes a regular occurrence. And that is the conundrum that Fed officials are going to be facing this week.
Well, that was the pace last week, Lisa, but we're there now where we're getting used to a 1.43%. We had guests today talking out to 170.
Sure, but if it's just a gradual increase, that's one thing. If it's a rapid, spike up to 1.61%, with people questioning the liquidity in markets and people wondering what's behind it and failed auctions and all of these types of things, that's not going to be positive.
No, and what Porcelli said as well when he was beating me to death. I mean, Lisa, okay, he and others are at 6%, but he laid out the what ifs that get you to ginormous economic growth. I don't think that's in the market.
No, and the question is, if you do get ginormous, to use your word, economic growth, what does that do to the long-term inflation expectations? Does it force the Fed's hand to move faster? Does it lead to a slowdown in some of the investments that might lead to faster growth longer term? These are some of the things. I just keep going back to the uncertainty. That's why I was talking about Jonathan Golub and the idea that he was keeping on revisiting his estimates for the S&P. Yeah. How do you get visibility in an economy like this?
What's high yield done over the last 3 sessions?
High yield's done a lot better than investment grade. I mean, you have seen yields, all-in yields rise as the spread also increases, but it's held up much better than investment grade.
Yeah, because what? Credit worries are not that difficult in a 6% economy, right?
Well, and because the cushion's that much bigger, it doesn't have as much duration risk.
Listen, duration risk. Okay.
It's not as pinned to the Treasury yields and moves in the Treasury yields.
Okay, that's a great. I have
Tom,
no
I love you.
What she's talking about. I know.
I love you.
But
that was
a
great question.
Just wrong. Yes, I just killed it. Let's stagger out of this as we can with an up 1% move. Futures up 44. Dow futures up 355 points. I got a 3 big figure move in VIX. Optimistic 24.73. Today, the Vice President of the United States will join Bloomberg on CityLab, and James Dimon will be along in the early afternoon hours. Stay with us on radio, on television. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income. I'm Jonathan Ferro. This is Bloomberg Real Yield. Your equity market bouncing back from New York City for our audience worldwide. Good morning, good morning. The countdown to the open starts right now with 30 minutes until the opening bell. Equity futures up 44. We advance a little more than 1%. Let's get this started. We begin with the big issue. The market's gearing up for a big week of Fed speak.
As the Fed speakers get rolled out, the market is very unclear as to what the Fed's reaction function will be.
Last week was a bit of a roller coaster.
We've got disruptive yield curve dynamics.
Sharply rising interest rates.
Central banks being very sanguine about the steepening of the yield curve.
The market's testing the Fed. The Fed appears to be losing control. How do they come out and say, look, we're still going to be very accommodative?
The Fed needs to step in.
The Fed has to come in and act as a circuit breaker.
There's a justified rise in real yield.
Yes, rates are going to go up.
The central bank shouldn't be trying to fight.
The best thing they should do is actually do nothing.
It's going to be very, very delicate.
The Fed is in a very difficult position.
Who wants to catch a falling knife?
No one wants to step in and catch the falling knife.
Catching the falling knife. Fed speakers flooding the calendar this week, starting today, with Brainerd and Williams speaking within the hour. Let's get to the Bloomberg team. Sarah Ponce, Michael McKee. Morning, Sarah.
Hey, John. Well, there will be plenty for the markets to digest after this global bond sell-off that we have witnessed. And to this point, where we stand now, you do have some Wall Street strategists saying this has gone too far. And they are suggesting that some buy the belly of the curve because they say that rate hike expectations, well, they're just way too aggressive right now. So take a look at those who have actually made these recommendations. JP Morgan, for one, recommending buying 5-year notes. TD Securities is also doubling down on their bullish stance on 5-year notes as well. Barclays says buy 3-year notes, and Citigroup recommends buying, well, the belly of the curve. But here is the setup, the backdrop for all of this, especially after the RBA doubled down on their bond buying, their bond purchases, announcing plans to buy more than $3 billion worth of longer-dated securities. That, of course, after their announcements to buy shorter-dated securities just last week. So this morning, we see risk on tone back and forth. So you look at equity futures, S&P futures headed higher at more than 1%. We do see a rebound this Monday morning. In Europe, we see equities higher, too. In the U.S., we do see bond yields ever slightly higher. Your 10-year currently at 143, but nowhere near the 160 that we did top last Thursday. Elsewhere across the globe, though, that's not really the case. You do see oil prices moving ever slightly higher, too. Brent crude oil now nearing $65 a barrel. At the same time, though, what this has meant, though, is around the globe, as yields rise, of course, that means less negative yielding debt. And that has put a question mark over the TINA trade, you could say. Last year, we ended the year about $18 trillion worth of negative yielding global debt, John. Now, after this really swift rise in bond yields that we've seen, that has now lessened to around $12.5 trillion as we stand, John.
Some people hoping we get back to zero sometime soon, Sarah. Doubtfully it can happen. Sarah Ponce, thank you very much. So we've had some pushback here. This bond market has received some pushback. It's received it from Europe, from Australia. It has not received it from the United States, the Federal Reserve. Richmond Fed President Thomas Barkin striking a tone of optimism in the face of rising yields, telling Dow Jones the following: I would be disappointed if we didn't see yields rise as the outlook improves. I do think we're at the point where there's daylight on the horizon. Head of a week full of Fed speak. Here's Mike McKee. Morning, Mike.
Good morning, John. We'll find out how much daylight he thinks is coming because I'll be talking with Tom Barkin at 12:30 Wall Street time today on Bloomberg's Balance of Power. We'll get him to expand on what he's seeing in the economy, especially that inflation perspective that has everybody in the bond markets worried. Other than that, most of the Fed speak today is off topic. John Williams starting this hour with an introductory remarks to a conference, but Lael Brainerd will be talking about financial stability, and of course the bond market's been anything but stable over the past year. Bostic, Mester, Kashkari, that's on race and the economy. Probably not a lot of economic forecasts there. But then we start with Tuesday. Brainerd is back. Mary Daly from San Francisco. On Wednesday, we get 3 Fed speakers and the Beige Book. A lot of interest in the Beige Book and what it tells us about whether companies are raising prices or not. Thursday, of course, the big kahuna. Jay Powell speaks, Economic Club of New York. He's going to give us his view on what is happening in the economy, and you can bet every set on every trading desk will be tuned to that on Friday. Bostic back again, and they are, as we were just talking about, saying, looking at what's happening in the markets, the 5-year note yield, the focus of everybody, buying the belly, as John was saying, and you can see on the right-hand side how we had that spike last week, and it's come back down. It's still down today. The 10-year yield is a little bit higher, but the Fed's got to thread the needle and make sure that doesn't go the other way while they're watching a lot of economic data. And of course, John, this is the big week. ISM manufacturing coming up at 10 this morning. We'll look at prices paid there, and of course, we'll look at employment. Auto sales tomorrow. Fed low rates, keeping that going. And then ADP and ISM services on Wednesday. ISM services getting more attention these days because everybody wants to know if the service industry, restaurants, et cetera, are coming back. And then Thursday, jobless claims. Friday, we end on the big one. It's Jobs Day on Friday, and even though that's backward-looking data, it'll play into what everybody's expectations for the upcoming Fed meeting are, because Saturday the Fed goes into the blackout. We won't be hearing from them next week. We won't hear from them until St. Patrick's Day, when we get the latest Fed decision.
That Fed meeting is going to be fascinating. So Guy Johnson, Alex Steele will run you through the ISM out in about 55 minutes' time. Mike, before we let you go, I'm trying to gauge what the Fed would be more concerned about right now. The volatility, that huge intraday move that we saw at the long end, through the belly as well, on Thursday, the drift higher on 30s as well, or just the very fact that people are starting to price in more hikes in a not too distant future from the Federal Reserve.
They're going to be looking at the volatility because that is a suggestion that maybe there are problems with market functioning, which they would have to deal with. But if markets are functioning okay, they expect people to be a little skeptical of their new reaction function. The idea that they're going to wait and let inflation go a little bit higher, and they're just going to have to keep repeating that in ways that don't scare the market. We'll get a lot of opportunity this week.
Mike, thank you. Mike McKee will be back at about 9:45 Eastern, so about 40 minutes' time to run you through the PMI here in the United States, ahead of that ISM out in about 54 minutes away. BlackRock's Marilyn Watson expecting a supportive Fed to stay the course, writing the following: we believe the Fed will continue to keep rates lower for longer. Recent communications from Chairman Powell have reiterated the central bank's strong commitment to supporting economic repair. Marilyn, I'm pleased to say, joins us right now. So Marilyn, let's start with this one. Thursday, Chairman Powell, does the script shift in any way, shape or form?
I don't think so. I think the comments that we heard last week from Chair Powell, or also from other members of the FOMC as well, I think Chair Powell was really very, very deliberate last week in terms of really ensuring that there was no new Fed speak, so to say. They had a slight improvement possibly in terms of GDP, but I think really the Fed has made it crystal clear that they have a dual mandate. They want to support an economy that has full employment as well as their inflation target. With their new framework for monetary policy, they can let inflation run a little bit hot if they need to. And I think that the Fed is really making it crystal clear that we have seen some repair in the US economy, but there's still a very, very long way to go. So I think this week, all eyes, as you say, will be on his speech on Thursday. But I really think that, for the next few weeks, and certainly before the FOMC in a couple of weeks' time, he's going to be very, very, very sure that he's just going to steer sort of a steady ship right now.
Marilyn, being comfortable with long-end yields drifting higher, seeing that as a statement of confidence is one thing. Looking at the path for future interest rate hikes that the market is pricing, bringing that forward and starting to lift that path a little bit, that's another thing. Do you expect to see that reflected in the forecasts?
So we have certainly seen already a huge shift in terms of the market pricing, as you say. First of all, I think, it was spurred along by higher inflation expectations. We have more recently seen real yields pick up as well, but they are still incredibly accommodative. Having said that, yes, you're quite right. The market is bringing forward their expectations for, when rates might rise, as well as some potential tapering. But I think at the moment, we're really keeping an eye on the data. As I say, this week will be key when we see the data coming out in terms of payrolls, the unemployment rate. And we still are seeing a lot of volatility in the numbers. So while overall the US data is suggesting, a very strong improvement in the data overall, at a different sector level, we're still seeing huge dispersion between how the economy is starting to heal. And obviously, Mike McKay said that earlier as well in terms of manufacturing versus services. So the market is starting to price more in terms of maybe bringing forward a potential change in policy. There may be further to go depending on the data. At BlackRock, we certainly have a positive view on US GDP growth this year. But for now, I think the market is really going to be very, very keenly watching the data and see whether they can sustain this improvement.
I want to pick up on that word you used, dispersion. We're set to see a lot of dispersion in this recovery, largely because of the vaccination rollout, the UK versus Europe, the United States versus Europe and elsewhere as well. Marilyn, do you expect to see that dispersion in the bond market? Because what we saw last week was just one big trade, one global bond market trade, Europe, the US, Australia, yields absolutely flying. Do you expect to see the dispersion that you expect to see in the growth reflected in the bond market?
I think we will. I think we will start to see that. I think, as you say, the moves that we saw recently were really, by and large, triggered largely by moves in the US and the view on the US economy. And I think now we are seeing dispersions. You know, when you look at the data in Europe, it is improving, but it's very, very mixed, and the vaccine rollout is certainly slower. If you look at the UK, I think you know, a lot of market observers have been surprised at how quickly the UK is actually rolling out the vaccines, and certainly the first dose, and you know, many people are now waiting for the second. So I think when you look at the dispersion, we, for example, now have a much more positive view of the UK economy. We're now short duration in the UK. We think that the prospect for negative interest rates in the UK, for example, now have significantly diminished. So we do think we will, you know, continue to see positive improvements in growth, you know, globally and particularly across developed markets. But I do think we will see, after this initial movement and the initial reassessment by market participants of data, of potential inflation, of potential global growth, we will now, I think, start to see a little bit more volatility and dispersion between the different bond markets.
Marilyn, lucky to have you with us this morning. You're sticking with us. Let's get to the story of the moment. Up 42 on the S&P. We're up 1.1%. At the market desk with your movers is Abigail.
Good morning, John. And it certainly is a risk-on mood. This after the S&P 500 fell for 2 weeks. We have investors firmly going back into risk assets. And importantly, lots of the key names and sectors, starting out with Apple, which was actually down 3 weeks in a row. The first time we've seen that since September of last year. We have the stock popping up about 1.8%. Not for a particular reason, but it's more a bet on risk, given the fact that this stock is somewhat technically damaged. So some buy the dippers in there. Certainly true for ExxonMobil, the energy sector, flying in sympathy with oil, so that reflation trade. True, too, for the banks, climbing as yields are up just a little bit today. Goldman Sachs up 1.1%. And speaking of Goldman Sachs, there, of course, is a Bloomberg exclusive that Walmart is popping on the news that the company has hired 2 Goldman Sachs bankers to help them lead, if you can believe it, a new fintech startup. So lots of important gainers there. It's true, though, as well for the speculative space. If we take a look at Palantir, shares are sharply higher on the news that Cathie Wood's ARK added 3.4 million shares to its fund. Riot Blockchain rioting and rallying in sympathy with Bitcoin, which is up about 6%. Riot Blockchain up 12%. And then finally, John, you can't go another day without these game stocks, the Reddit stocks climbing, AMC popping.
Flying. Abby, thank you. Coming up, J&J's one-shot vaccine receiving clearance for US distribution. That conversation up next with Marilyn Watson of BlackRock and Morgan Stanley's Sri Sankaran. Looking forward to that from New York City this morning. Good morning. 18 minutes away from the opening bell, a bounce in this equity market, a lift on the S&P. This is Bloomberg.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We're going to launch a massive campaign to educate people about the vaccines, that they are safe and effective, and that they can go and get those shots and be good.
People need to get vaccinated as quickly and as expeditiously as possible. And if I would go to a place where they had J&J, I would have no hesitancy whatsoever to take it.
The Biden administration urging Americans to take any available vaccine as soon as possible. That coming on the heels of the CDC's approval of Johnson & Johnson's new one-shot vaccine. Let's get across to Bloomberg's Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, we now have a third vaccine in circulation here in the U.S. Deliveries of Johnson & Johnson's doses should begin as early as tomorrow. The shares are up about 2% in pre-market trading as this process gets underway. Of course, this vaccine is different from Pfizer and Moderna's vaccines that are already being rolled out because it only requires one dose and can be refrigerated for 3 months rather than frozen. So that makes the distribution and administration of this shot a bit easier. Now, J&J will deliver the first 4 million doses this week, with 20 million doses promised by the end of the month and as many as 100 million doses promised to the U.S. by the end of the first half of the year. And of course, as Dr. Fauci was alluding to there is a bit of a confidence question involved here, given the efficacy rate of this one-shot vaccine was lower than Pfizer and Moderna's in the clinical trials. But again, the administration encouraging to get people to take any shot they can because they are trying to get this vaccine rollout going as quickly as possible. As it currently stands, the vaccine cases here in the U.S. The vaccine has more than 75 million vaccinations have been given in total. The latest weekly average as of the past week was 1.74 million doses per day. At that rate, it would take about 8 months to get everyone 75% of the country vaccinated with a 2-dose vaccine, but given J&J's, again, is a one-shot vaccine, John, that could mean we reach that 75% threshold a little bit faster, John.
1.74 million. Terrific numbers. Kelly, thank you. And look out for our interview a little bit later. I think about 12 p.m. Eastern time. We're catching up with the J&J CEO, Alex Gorski. Looking forward to that conversation. 15% of the population have had at least one shot in the United States of America. 7.5% fully vaccinated. Let's get back to the team. Morgan Stanley's Sri Sankaran joining us now alongside BlackRock's Marilyn Watson. Sri, I remember you and I caught up a number of months ago and talked about shortening up duration. A short duration asset still the place to be in this environment we're living through right now in this market?
Absolutely, John. I mean, the way we're positioned or recommending that investors position is to kind of stay down in quality where the rates exposure is lower and the spread cushion is higher within the credit markets. Leverage loans over high yield has been a call that we've been talking about for almost 6 months now. That's still very much in place. I think the one kind of shift that we have done in recent days is to trim duration exposure within the fallen angel complex, which have rallied a lot. So these are 3 elements of our thesis now.
Let's break that apart just a little bit. Marilyn, are you in that camp as well? High yield over IG, loans over credit, so to speak, in the moment?
So we have rotated out of the higher quality IG into lower quality or into high yield as well. Yes. So we do think with the potential for a more reflationary environment, the lower duration, and for the potential for spreads to compress more with high yield and IG as well, then we are certainly in the similar. We've also, to a certain extent, increase our cash positions. So we have some dry powder. We have that as a ballast as well. So we have increased our high yields and we've increased our cash positions too.
Does that cash position replace, say, 10s, 30-year treasuries, Marilyn?
Yeah, so at the moment it's hard to see how sort of longer duration treasuries can really act as a hedge in the current portfolio. We do expect to see sort of yields drift higher eventually, and we do think that they will eventually perform that function again. But in the current environment, We do think that sort of as a hedge and just as dry powder, as we're seeing these market moves and we do see opportunities where we can invest in other areas of the bond market, then we're ready to go as well. So to a certain extent it has, yes. To a certain extent we still have much lower duration positions and we're not quite there yet in terms of going back to longer duration treasuries as a hedge.
Sri, being familiar with the Morgan Stanley view of the world, I'd be surprised if you told me that you were keeping big cash positions or even any kind of cash allocation at the moment, Sri. Can you walk me through how you think about holding cash at the moment?
So, I mean, that is a tough one. I mean, thankfully, as strategists, that's not a live day-to-day problem that we deal with.
Yeah,
but in terms of our overall allocation, I would say that taking profits in some of the longer duration assets which have outperformed in recent weeks and months, and that's kind of why the fallen angel complex comes into play. I think that does make sense, and to hold off for some degree of rate stability before reinvesting. So I do not think that it'll be like minimum cash position that we would advocate, but clearly it would be kind of more risk on and looking for opportunities in a more stable rates environment to reload on that trade.
Well, last week certainly wasn't stable. I apologise for the technical issue there. Had a lot of echo in my ear. Don't know if you could hear it, but if you could, I apologise for that. Marilyn, last week certainly was not stable in this Treasury market, and yields inflected higher, much higher on 10s and 30s. And coming into this, so many people came on programs like this, including this one, talking about shortening duration, worried about rate-sensitive parts of this market. They were right to be. They were right to be in loans. They were right to be in high yield over investment grade. They were right to pull back from 10s and 30s. We've seen that trade. Marilyn, I'm trying to understand when you step back in, the levels to step back in. 161 on Thursday. These were levels people didn't think we'd hit for the whole year. What's the right thing to do with that approach?
Well, so I think over the next few weeks, few months, as we do continue to see confirmation potentially of the really very, very positive growth in the US, as we continue to see the rollout of the vaccines and elsewhere, we are seeing volatility at the moment as the market is reassessing its view, which is very different now from a month, 2 months ago, in terms of where we think inflation may be, where we think US and global growth may be as well. So I think we need to look through this volatility. We do see the underlying path as being very positive in terms of growth, but I think it's looking through the noise. And, you know, we do have a very positive view overall of risk assets. So as I said, we like high yield, we like some areas of emerging markets, we like securitized. And, you know, we certainly like areas of the equity market as well. And I think it's looking through the volatility, looking at the fundamentals, and really looking to where we're going to see the markets and growth data and rates in 6 months, in 1 year's time.
Sri, let's get a final word with you on that. And once again, I apologise for the technical difficulties just moments ago. Just a word on how we approach the rest of the year. Do you expect the conditions that you looked to materialise back 6 months ago when you and I talked about this to persist through this year? Or do you think this is a story just for the next couple of quarters and at some point you'd put that duration trade back on?
I think that at sometime back half of the year, there will be an element where you do kind of reload into portions of the investment grade market, which are longer duration. And to be honest, that's one pocket that we've still kind of argued that from a returns, excess returns or a spread perspective, that should benefit, given the demand from yield buyers stepping back in a higher rates environment. So I do think that to the extent that it's not a straight line, and that's not what we're calling for with respect to treasury yields, there will be a window later in the year where we would want to add back more duration.
Lucky to have you both with us this morning. Sri Sankaran of Morgan Stanley, Marilyn Watson of BlackRock. Coming up, the analyst action you need to know. That'll be next in our morning calls. And later, pandemic laggards turning into leaders with recovery optimism growing. That conversation's still ahead with Nuveen Sarah Malik and Washington Crossing's Kevin Karen from New York City this morning. Good morning to you all. It's Monday morning. Stock's looking nice. A bounce on the S&P up 46. We rally by 1.2%. This is Bloomberg.
Okay guys, if you're planning to sell British pound, I'm looking to sell at 139.415. Order placed, sell short at 139.415, just right here. So if you're looking to sell British pound, here is your chance. You can follow this trade and you can make a profit from it. Okay? Speak to you later.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
The past 10 years have seen the rise of names like Siri and Alexa, EVs like Tesla's Model S, wearables like the Apple Watch. What will the next decade bring? Catch a special edition of Bloomberg Technology, 10 years of innovation on Bloomberg Television.
We're 5 minutes away from the opening bell. It's Monday morning. Equity futures with a bounce on the S&P up 46. We advanced 1.2% on the S&P 500, taking a little bite, a nibble, out of last week's big loss. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin first up with Truist, upgrading Wayfair to a buy with a 370 price target. The analyst forecasting an extended period of healthy sales growth following the pandemic. That stock up by 1.42%. Your second call from Goldman, raising its DraftKings price target to 73 after its most recent earnings beat. The analyst expecting recent momentum to fuel a faster path to profitability. That stock up by almost 3.5% in early trading. And your third and final call from the team at Bank of America, upgrading ON Semiconductor by 2 notches, rising shares to buy from underperform. The analyst seeing further upside amid rising automotive content and restructuring tailwinds. That stock up by about 4.5%. Coming up, investors buying the dip amid rising optimism over the economic recovery. That conversation up next with Nuveen's Sarah Malik and Washington Crossing's Kevin Kerrin. Then later, JP Morgan's Jamie Dimon joining Bloomberg TV and radio. Looking forward to that from New York. This is Bloomberg.
It's extremely exciting for the university, for being a historically black college and university. It's just exciting for our engineers to actually be allowed to work for a large firm such as Boeing with such technologies that we can see the outcome.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into this SPAC thing a little bit before it became such a hot method of going public.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
"25 seconds away from the opening bell. Equities with a bounce on the S&P 500, on the Nasdaq, on a Russell, up 188 on the Nasdaq last week. The biggest weekly loss on the Nasdaq going back to October. On the S&P, the biggest weekly loss, I think, in about a month. On the S&P 500, up 49, we advanced 1.3%. There's your opening bell. Switch up the board in the bond market. If I asked you to guess, how big was the move on a 10-year nominal yield last week? Would you come up with about 7 basis points? I doubt it. It felt much worse than that, didn't it? 143 on 10s. Your intraday high on Thursday, 161. Up a couple of basis points this morning. In the FX market, the euro just bleeding a little bit lower. We're down 0.2%. Euro dollar 120.54. And in the commodity market, crude giving up this morning's bid, 61 handle, $61 and about 50 cents. That's the cross-asset story this Monday morning. At the market desk with your movers, here's Abby.
John, let's dive into the risk-on tone at a stock level. And one reason for some of the optimism that we're seeing, J&J, of course, emergency authorization of their one-shot vaccine. Those shares are popping higher, and as a result, the reopening trade is in full swing. The travel stocks, your airlines, your hotels, and your cruise lines all trading higher. So lots of optimism there around the reopening trade. Another piece of it, of course, is the reflation trade, and we have that working too, as some of the big energy names are climbing, including Chevron and Occidental Petroleum. The banks up in a big way also. Bank of America up nearly 2%, and Citigroup, take a look at that, up 3.2%. This, of course, as Jane Fraser, the first female CEO of a big bank, she starts today. So that stock appears to be up even more than the group. And then finally, John, the biggest weightings to all of the major averages, Apple and Microsoft, nice rally here. You have almost $4 trillion worth of market cap on that one board. These stocks have been down in a big way. Apple in particular down 3 weeks in a row, trying to break that streak on this Monday, John.
This rally is broad-based. Abby, thank you. About 90 seconds in, up 1.4% on the S&P 500. Every single sector I'm tracking right now on my screen is in the green. Energy up by a little more than 2% on the S&P 500. On the financials, up by a similar amount. Same as IT, information technology, up by 1.65%. Investors buying back into the reopening trade then. Following the recent turmoil of last week, Goldman's Peter Oppenheimer expecting a pickup in growth to add fuel to the narrative.
There is an interplay between, value and growth and what's happening to bond yields. The underlying trend here is pretty clear that we're moving into a period of very strong synchronized global growth. These conditions are still very favorable for cyclicals and value, and we think that has further to go.
We think this has further to go, and he's not alone. Here's Sarah Ponzek for more. Hey, Sarah.
Hey, John, he's certainly not alone, but today after the bell, at the intersection of the...
Okay, guys, I have to cancel this order because it moved far away from my order, and because we're day trading, it's not much point to hold it for a long time. If it's moved far away, I need to cancel it. Okay, I'll speak to you later. I'll let you know when new chance, new opportunity will arrive to trade British pound. Okay? Speak to you later.
From this point in time. So, of course, the flip side of that, because you look at Zoom video, down more than 30% from